Hello everyone and welcome to the course Islamic Banking, Finance and Investment from Religious Text to Modern Application. This is an original course from Mosaicdemy, and if you find this video beneficial, please consider signing up to our website where you get access not just to this course but to our entire course library. This course is designed to provide students with an in-depth understanding of the Islamic banking and finance discipline. Within this course, we will cover the most popular Islamic finance models. We'll see how they have been derived from the original religious sources and how they are applied by Islamic banks in the modern day and age. We will also look at Islamic investment and cover various different investment options such as stocks, bonds, mutual funds, and the like to see whether investing in them is Sharia compliant or not. The intended audience for this course is primarily business, accounting, and finance students. It is also very relevant for Muslims who are looking to learn more about their discipline so that they can better practice their religion. We have tried to clarify any jargon and terminology used within the course, whether it be Islamic or financial, to make the subject matter more accessible to non-Muslim students who are interested as well. So please note, since the course deals with religious topics, it is essential that we take these from credible sources. So references are given to all Quran verses which are mentioned in the presentation. This includes both the surah and the verse number, the surah being the chapter. And all these references can be checked on Quran.com. Likewise, references are given to all Ahadiths that are mentioned in the presentation, both the book name and the Hadith number. And these can be checked on Sunnah.com. The Quran and the Ahadith are basically the primary sources for the Islamic religion. Any major ruling or principle within Islam needs to be traced back to these sources, and we have given references to anything mentioned from these sources within the presentation. Likewise, links to all the relevant fatwas are given in the description below. Fatwas are rulings made by Islamic scholars based on the Quran and the Ahadith, where they usually determine whether something is considered halal, which is permissible, or haram, which is prohibited. So anything that is called halal or haram in this presentation is based on the fatwas given by credible scholars, and the links to these fatwas once again is in the description below for anyone who wants to check. Also, just a disclaimer, this presentation is for educational purposes only. While the presentation covers various finance topics, it is not to be used as financial advice. Any financial decisions you make should be as per your own research and discretion. Also, we are not speaking in favor of or against any Islamic banks mentioned in our examples. So as part of the presentation, we use real-life examples from Islamic banks' websites to show how different models are applied by them. But just because we mention these Islamic banks in our illustrations does not mean we are speaking in favor of them or against them. With that said, let's go through the course breakdown. We're going to start with the first section where we cover an overview of Islamic finance. Within this section, we'll give you a background about the discipline, the context in which it evolved in the modern day and age, as well as cover some of the core principles of Islamic finance. From there, we'll move on to the next section where we cover the Islamic basis for Islamic finance. In this section, we'll cover different Quran verses and authentic Ahadith to see what they say about various types of financial issues and financial transactions. This will give us a good idea about what is considered prohibited and what is considered permissible in Islamic finance. From there on, we'll look at the most popular Islamic financial models used in the modern day and age, which have been derived from these original Islamic sources. We'll cover these models in details, look at the various Islamic considerations relating to them, and also look at illustrations about how Islamic banks apply them in real life. Following that, we will look at Islamic investing. So we're not just going to cover Islamic banking and financing, which has to do with where you get money from, where you get finances from. We're also going to look at Islamic banking and where you can invest or put your money. And in this section specifically, we're going to look at popular investment options in contemporary finance, such as stocks, bonds, mutual funds, real estate, and the like. And we're going to see whether investing in these is halal or haram from an Islamic standpoint. Then, in the last section, we're going to cover other relevant financial matters. These include insurance and pension schemes, which are relevant to more or less all of us. So with all that said, we will start with the first section, where we cover an overview of Islamic finance. So let's start with the background and give a context as to how the modern-day Islamic finance industry came to be. So Islamic finance is an attempt to modify the existing banking and finance system to make it compliant with the rules of the Sharia being Islamic law. And this is important to understand because Islamic finance as a separate entity is a modern-day phenomenon. In the past, when Muslim lands were under Muslim rule, there weren't many un-Islamic practices taking place within the economy or within the financial industry. As a result, there was not a need for a separate discipline of Islamic finance. Islamic finance was just regular finance. However, after colonization and most Muslim countries coming under European rule, there were a lot of practices introduced within the economy, within the financial industry, that did not adhere to the rules of the Sharia. And post-independence, with the rise of Muslim countries, a lot of these rulings, a lot of these systems are still in place. So the modern Islamic finance industry is not so much as an independent alternative system set from the get-go. Rather, it is the understanding by Muslim scholars that, okay, we have a system in place with a lot of rules which are against Islam. We have to work within this system for the time being because it's not going to change overnight. So what can we do to carve out a niche within this system where the rules of Sharia are being followed properly so that Muslims can properly engage in the financial industry? And it is important to keep this attitude in mind because it will help us grasp the nuances of certain things as we move forward. So as we said, the modern-day financial system, which is primarily inspired from the Western world, has a lot of aspects within it which are against the rules of the Sharia. For example, in the Sharia, there is an emphasis on removing haram meaning prohibited, elements from the system. This includes matters such as Riba, which is interest or usury, gambling, and other harmful products and services. So within Islamic finance, you are not allowed to engage in such practices. As we said, historically, there was not much need of a separate discipline of Islamic finance since riba, interest, only became widespread in the past few centuries with the advent of paper currency and the banking system. So the modern-day financial system is based on this interconnected banking system between nations and paper currency. And this has given rise to all sorts of transactions based on interest, but with other complexities involved as well. And historically, you didn't have this. You had currency in the form of gold or silver, or in the form of bartering. And charging 2.5% interest on 2 goats and a chicken is far more difficult than charging interest on a $1,000 bill. That is not to say that these practices were non-existent in the past, but they were far more uncommon and they were far more simple. So within this modern day framework of this complex banking system, with all these different types of financial transactions, we have Islamic finance, which is a growing niche within the industry. Nowadays, the Islamic finance industry is a fast-growing alternative to the conventional banking and finance system. So for example, here we have a market share of Islamic banking compared to conventional banking within different Muslim countries. How accurate this graph is, it depends because it is a bit old. So now the percentages will probably be a bit different, but it gives you an idea that Islamic banking is spreading all across the Muslim world. So now that we have a bit of an idea about the background of Islamic finance, let's talk about the history of modern Islamic banking. So we have a timeline over here. So the conceptual phase of Islamic banking in modern terms began in the 1930s. At this point in time, most of the Muslim world is under colonial rule by European powers. But at this point in time, it is also true that these powers were weakening, and there was a high expectation within the Muslim world that they would be able to get their independence sooner rather than later. So at this point, Muslim scholars came together and said, okay, we have all these un-Islamic practices within our economy, within our financial system. We need to find an alternative. We need to find a way to fix them. And this is how they started thinking of Islamic banking. By the 1960s, you had the initial phase where you had practical institutionalization. So at this point, most Muslim countries had gained independence, and they were now able to run their own affairs. At this point, this abstract concept that the scholars had in their mind, they could now put it into practice. And how can we bring Islamic principles back into the Muslim world when it comes to the banking and financial system? And within the 1970s, they were starting their first steps of execution. So in the 1970s, there were many noteworthy meetings and conferences taking across the Muslim world, with various Muslim countries participating. So you had, for example, the Conference of Finance Ministers of the Islamic countries held in Karachi in 1970. You had the Egyptian study in 1972. You had the first International Conference on Islamic Economics in Mecca in 1976. Interestingly enough, in 1976, you also had the end of the Bretton Woods system. The Bretton Woods system ending meant that all the major currencies in the world became what is known as fiat currency. So, like we said, historically, currency used to take the form of gold or silver coins. And when we moved to paper currency because of the convenience, because it's hard to move around gold and silver, they're heavy metals, initially the paper currency was based on what we call a gold standard. So the US government, for example, if they had US dollars that they printed out, they did so only based on the fact that they had a reserve of gold supply. So the value of these pieces of paper that they called US dollars came from the fact that there was an equivalent amount of gold stored by the US government. So the US dollar's value was based on that gold, and same for any other currency for that matter. But with the Bretton Woods system ending, all major currencies moved away from the gold standard, meaning they no longer derived their value from gold, rather their value came from just the brand name of the underlying government itself. So now the US dollar's value comes from the fact that the US government says this piece of paper is valuable. And the same applies to any currency around the world. Its value comes from the fact that its government says that this piece of paper has value. Now, the reason I brought this up over here is because this is very much far removed from Islamic finance in general. As we will see, within Islamic finance, there is a core principle which suggests that anything that you have within transactions or of transactional value needs to have an underlying benefit, an underlying value in its own right. So gold and silver is good for currency because even if it's not used as currency, it has value. It has many industrial uses and the like. But paper currency is problematic because if it's not used as a currency, it has no actual value in its own right. It's just a piece of paper. And while paper currency backed by gold is fine, paper currency not backed by anything, just backed by the words of a government, is not fine. So once again, we have a modern day system where this fiat money is present all over the world, and Islamic banking is trying to work within this system to try to make it as Islamic as it possibly can. So after the 1970s, you had the initial growth and regulatory infrastructure building phase. So within the time frame of 1975 to the year 2000, systems were set up, Islamic banks were set up. You also had the advent in 1991 of the IOC standards, which we'll look at in a bit, which were basically there to standardize Islamic banking practices. From the 2000s onwards, Islamic banking started to grow rapidly within Muslim countries. This growth was further increased after the 2008 financial crisis, because some of the main reasons for the 2008 financial crisis, such as lending in excess, are things which are directly in contradiction with Islamic financial principles. And around that time, a lot of people started talking about Islamic finance being a viable alternative to the current banking system to avoid such financial crashes. And from 2010 onwards, after the financial crisis, Islamic banking has become well established in the world and is known not just in the Muslim world, but outside the Muslim world as well. So much so that even non-Muslims study about it. So, for example, in the ACCA, in their finance papers, they do have sections covering Islamic finance. Same for CFA, because it is a noteworthy niche within the financial industry. So we mentioned IOFI. What is IOFI? IOFI stands for Accounting and Auditing Organization for Islamic Financial Institutions. Just like you have accounting standards, right? You have the IFRS or US GAAP, which try to standardize accounting practices throughout the world. You have other standards as well for environmental regulations, for example, right? For food and health and safety regulations. In the same manner, you have the IOFI standards to standardize Islamic banking practices. So IOFI was established in 1991 and is based in Bahrain. It is the leading international not-for-profit organization primarily responsible for development and issuance of standards for the global Islamic finance industry. It has issued standards in the areas of Sharia, accounting, auditing, ethics, and governance for international Islamic finance. So typically, an IOFI standard includes the following. It includes the ruling of the standard for a particular subject area. Just like in the IFRS, you have different accounting areas, right? You have inventory, you have fixed assets, and you have different standards for these. In the same manner, you have different standards for different Islamic finance concepts and Islamic models within the IOFI framework. So each standard includes the rulings of the standard, a history of the preparation of the standard and any changes that came about, and the Sharia basis for the standard. This is very important because, like we mentioned before, Islamic banking is not just based on some random person's opinion. All the Islamic models that we use come from authentic Islamic sources, meaning the Quran and the authentic Ahadith. And these standards mention these sources that were used to determine the rulings within the standard. And a lot of these standards were used in preparing this presentation. So what would be some examples of these standards? Examples would be the first standard, which talks about trading in currencies. You have Standard 13, which talks about the Islamic financial model of Mudarabah, which we'll look at later on. We have Standard 37, which talks about credit agreements. So the IOFI standards are a good place to look at for when trying to learn about the core aspects of Islamic finance. And these standards are available for easy download on the IOFI website. Now, before we go any further, let's talk about some common misconceptions about Islamic finance, primarily found within the Muslim world. So the first misconception that is very common is that it is only haram to receive interest, not to pay it. So most Muslims know that riba is haram, meaning prohibited, and one of the reasons it is considered haram is because it is considered exploitative, in the sense that someone needs money and they come to you for a loan, and even though they need help, you're actually charging them interest on top of that loan. So you're actually making money off of their neediness. So a lot of Muslims, because of that, have this understanding that yes, it's bad to receive interest because you're exploiting someone. But if you're the one willingly being exploited, meaning you choose to pay interest on a loan, then that's fine because you're the one being exploited and you chose to do so. So it's fine. But no, that's not true. So it is reported in Sahih Muslim. So when we talk about hadith sources, there are many different books. The most authentic within all of these sources are Sahih al-Bukhari and Sahih Muslim. These are the two primary sources of authentic ahadith. The word Sahih means that these are authentic ahadith of the highest order. In other words, we can take whatever hadith we find from Sahih al-Bukhari and Sahih Muslim and consider it authentic. So it says in Sahih Muslim, hadith number 1598. It was reported by Jabir radiallahu anhu. He said that Allah's Messenger, peace be upon him, cursed the acceptor of interest and its payer, and the one who records it, and the two witnesses. And he said they are all equal. So in Islam, there is a common idea that whenever you have a transaction or a contract, you need to have witnesses overseeing the whole process so that in case there's any dispute, the witnesses can be brought forth. So that's why there's a mention of 2 witnesses here. But as you can see, it is prohibited not just to accept interest, but also to pay it and even to record it. So for example, if you're an accountant who works with a company that undertakes interest-based transactions and you're recording that, that is also prohibited within Islam because interest is considered something very destructive to society. The next common misconception we have is when people say that Islamic finance is just the same as regular finance, they just put on the Islamic label. So they just put on a halal sticker, but otherwise it's pretty much the same thing. And this misconception is commonly spread by people working in the conventional finance industry who are dealing with regular interest-based transactions. But it is not true. And one of the main points of this presentation is to demonstrate where Islamic finance comes from, showing you that it comes directly from the Quran or from authentic Ahadith, and that it's not just something someone came up with and said, oh, here's a halal sticker, put on it, and now it's halal. No, that's not true at all. And a third common misconception that people have is, well, the reason that riba or interest is haram is because of the fixed element, that there's no risk in that return. You're going to get your interest paid to you of a fixed amount regardless of what happens to the other party. So it's the fixed returns which are haram. Variable returns where risks and rewards are shared, those are halal. But that's not necessarily true either. So within Islam, if we were to categorize different transactions between halal and haram, fixed rental payments. For example, you have a building, you rent it out to a company for their office use, and you collect fixed rental payments on that. That's perfectly halal because there's an underlying asset with actual utility, which is the building itself. But fixed interest rates, of course, are haram. By the same token, variable profits from trading. So if you set up a business, you trade different goods and services, and you make a profit, the returns are going to be variable. That's perfectly halal, provided that the business is all done in a halal manner. But if you make floating interest payments, which are variable interest payments, which vary with the level of inflation, that is also haram, regardless of the fact that it is variable. So the halal and haram aspects do not have to do with the fixed or variability of returns. Riba is haram, period, and certain transactions are halal, period, regardless of whether the returns are fixed or variable. These are common misconceptions that we find in Islamic finance, so it's important to talk about them first before we move on. So now, next up, let's cover some of the core principles of Islamic finance. If you have an idea of these core principles, you have an idea of the underlying current that you find within Islamic finance, and it will help you grasp how different Islamic financial models differ from conventional models. So first of all, certain industries are prohibited outright. For example, gambling, alcohol, pornography, weapons, manufacturing, commercial banks. These are outright prohibited, meaning you cannot run such companies, you cannot invest in such companies, and you cannot work for such companies. Then you have certain types of transactions which are commonly found in the modern financial system. These are interest-based transactions, riba, speculation or gambling-based transactions, for example, your derivatives and the like, and short selling, where you sell something you don't yet own. All of these types of transactions are outright prohibited. Trading, on the other hand, where you buy something for a certain price, let's say a box of apples, and you sell it at a higher price to make a profit, that is allowed because there is a huge importance placed on the fact that transactions should have an underlying asset. If you buy a box of apples for $100 and sell it for $120, the box of apples has a utility within its own right, and the buyer at the end of the day will use them, basically will eat them. But if you take a $100 note and loan it out to someone and they pay you back $120, $20 in the form of interest, then that transaction doesn't have an underlying asset. You're making money on top of the money that you already have. The money in itself has no value in its own right. And lastly, there is an emphasis on profit and risk sharing arrangements. So there are many different types of Islamic finance models. And as we saw, some people think that models that bring variable returns are halal, but models that bring fixed returns are not. And that's from this understanding that there is an emphasis on profit and risk sharing arrangements. So it's encouraged to engage in partnerships or what you call equity investments, because here the risks and rewards are shared between all parties. And what that does is that results in a more equitable distribution of wealth instead of situations where the rich get richer and the poor get poorer. That's why they're encouraged within Islamic finance. Islamic finance does not believe that everyone necessarily has to have the same level of wealth. So it's not that sort of system. It understands that there will be differences in level of wealth for different people based on differences in opportunity, differences in effort, and so on. But it does place an emphasis on the fact that there should be a more equitable distribution of wealth, meaning you shouldn't have a situation where there are obscenely rich people and obscenely poor people. There should be a balance, and rich people should be entering into profit and risk sharing arrangements with poor people so that the wealth is more evenly distributed. If things go well, everyone benefits. If things go badly, everyone still has the ability to share the loss between them, so losses are minimized across individuals, as opposed to a rich person just giving a loan to someone and making a guaranteed interest return back regardless of what happens to the other party. So we mentioned that certain industries are banned within Islamic finance. Let's look at those industries in a bit more detail. So you have tobacco. This includes drugs as well. So any types of drugs, cocaine, heroin, etc., all of these are banned under Islamic finance and indeed under the Sharia. Alcohol, gambling, meaning casinos and the like, weapons manufacturing, any kind of haram meat. So this means pork, but also meat that is not slaughtered in line with the Sharia. Any forms of adult entertainment, pornography and the like, the music industry as a whole, and any institutes dealing with riba. So it's not just about commercial banks. This could include insurance companies. This could include certain types of asset management companies and the like. If they're dealing with interest, then those types of transactions are banned. But that does not mean that banks in their own right or asset management companies in their own right are haram, just the ones that deal with these haram transactions. Now we can see there's a common recurring concept that we're talking about over and over and over again, which is riba. So let's try to understand what this concept really is. So riba means interest or usury. Now it's important to mention both these words, because another common piece of misinformation that you find is people saying that riba means usury, and usury is exploitative interest. Regular interest with low interest rates, that's perfectly fine. It's just the exploitative kind, the usury, that's the bad interest. That's not true at all. Riba means interest. Doesn't matter if it's 0.1% or 200%. If it's interest, it's riba and it's banned. There's no such concept of there's some interest which is exploitative and other interest which is not. And within riba, there are subcategories. For example, a famous one is riba al-fazl. Riba al-fazl is when you exchange the same type of item but in different quantities. This applies to certain types of items. For example, gold. So you cannot exchange 100 gold coins for 200 gold coins because it's the same type of item. This also applies even if that same type of item has differing qualities, as we'll see later on. But the general principle is like for like. If you have the same type of item, you can only exchange the equivalent amount. So if you have 100 gold coins, they can only be exchanged for 100 gold coins. But if you have something different, for example, gold and silver, then there can be an exchange. So that you can have 100 gold coins for 200 silver coins, right? But when it's the same type of item, it has to be equivalent, otherwise it is riba. And concepts like inflation and time value of money are irrelevant. I bring this point up because I had an interesting conversation once. Someone said, well, I'm not actually earning riba. You see, the inflation rate is 15%, and my savings account only pays 12% interest. So I'm actually losing money. So there's no riba over here. Again, these concepts are utterly irrelevant. A lot of what inflation and time value of money has to do with is fiat currency. Fiat currency, like we said, is not backed by gold, meaning the government can print this money as and when it feels necessary, meaning it has an open supply. It can turn on the tap at any point in time and print more money. And that, along with the obsession within GDP to make more, sell more, is one of the reasons why money supply is constantly increasing. When the supply of something increases, its value falls. So these are some of the driving factors behind inflation and time value of money. These concepts, while not non-existent in the past, were nowhere as impactful in the past, would be nowhere as impactful within an Islamic financial setting. So they are completely irrelevant to the discussion. It doesn't matter if the interest rate you earn is 1% and the inflation is 20%. That 1% of interest is still prohibited. Now, this firm stance that Islamic finance has against interest might seem unique in the modern world because every country engages in interest-based transactions. But again, that's not true at all. So, Riba is not just an Islamic issue. For example, if we look at the Bible, in Exodus 22, verse 25, you have, "If you lend money to any of my people with you who is poor, you shall not be like a money lender to him, and you shall not exact interest from him." Likewise, in Deuteronomy, in 23 verses 19 and 20, you have, "You shall not charge interest on loans to your brother, interest on money, interest on food, interest on anything that is lent for interest. You may charge interest to a foreigner, but to your brother you shall not charge interest." So you can see in the Bible, and by extension, meaning within Judaism and Christianity, interest is not seen as something good at all. And the prohibition on interest and usury was primarily removed over the past couple of centuries in the Western world. The Western world, being primarily Christian, of course, did not engage in interest either. It's only in the past couple of centuries, with the advent of paper currency and the modern-day banking system, that the Catholic Church and other Christian authorities gradually did away with the prohibition of interest. And unfortunately, then the Muslim world followed suit later on as well. But we can see that interest is not something prohibited just in Islam, but also within Judaism and Christianity. So while Islamic finance seems unique in the modern context in its stance against riba, this was not the case historically. So with all this said, now let's answer the all-important question that most people would have. Is Islamic finance actually Islamic? So one, there's the theory of Islamic finance, how it should be applied, what it is. That, yes, that is Islamic. And that's one of the points of this presentation. In the next few sections, we're going to look at how Islamic finance is actually Islamic, how these Islamic financial models are derived directly from the Quran or from authentic Hadith. But just because the theory is proper, does that mean the application is proper as well? Unfortunately, that is not always the case. So yes, there are many quote-unquote Islamic banks or Islamic financial institutions in the modern day and age which claim to be Sharia compliant, but a lot of their practices are not. But just because there are exceptions like those does not mean that every single Islamic bank out there or every single Islamic financial industry does not comply with the Sharia. No, there are institutes out there, there are banks out there that do comply with the Sharia rulings, and their activities are halal. And hopefully after this presentation, you will have enough knowledge to be able to distinguish between Islamic banks which are actually Islamic and ones which are not. So now that we have this foundation set, we can move on to the next section where we will talk about the Islamic basis for Islamic finance. So in this section, we're going to look at various different Quranic verses and authentic Ahadith to see where the modern day Islamic finance models and rulings are derived from. So just to be clear, the Quran is direct revelation from God delivered through the Prophet, peace be upon him. The Ahadith are narrations about the life of the Prophet, his actions, his teachings, where he expounds upon the principles and guidelines covered within the Quran. The Quran and the authentic Ahadith are considered the foremost sources of Islamic knowledge. So anything coming from these sources is the most authoritative ruling for a particular matter when it comes to Islam. Please note that references have been given for all the verses from the Quran and all the Ahadith used within this section. You can check these references by going to Quran.com to check any Quranic verses, or go to Sunnah.com to check any of the Ahadith mentioned over here. So let's start with the basics. The prohibition of Riba. How do we know that Riba or interest is banned within Islam? Well, we can go to the Quran. In Surah number 2, verses 278 and 279, it says, O you who have believed, fear Allah and give up what remains due to you of interest, if you should be believers. And if you do not, then be informed of a war against you from Allah and His Messenger. But if you repent, you may have your principal. Thus you do no wrong, nor are you wronged. So we can see in these verses there is a very severe warning against taking interest, and it is equated to go into war against Allah and His Messenger. The prohibition of riba is mentioned in other places in the Quran as well as in the Ahadith. So it is narrated in Sunan Ibn Majah, Hadith number 2279. It was narrated from Ibn Masud radiallahu ta'ala anhu that the Prophet, peace be upon him, said, there is no one who deals in usury a great deal to increase his wealth, but he will end up with very little. That is, his wealth will be decreased. In this hadith, the Prophet is clearly giving people the reason why most people will engage in taking interest, which is in an attempt to increase their wealth. But he's warning them that ultimately they'll end up losing this wealth in the long run. From the prohibition of riba, let's move on to the prohibition of certain categories of riba, such as riba al-fadl. We find in Sahih al-Bukhari, hadith number 2170, narrated Ibn Umar radiallahu ta'ala anhu, the Prophet, peace be upon him, said, the selling of wheat for wheat is riba, except if it is handed from hand to hand and equal in amount. Now these terms are important. Hand to hand is something that we have in modern day finance as well, called spot transactions, where we exchange something for something on the spot. We do not delay the exchange. And equal in amount, obviously meaning that if you have 100 kg of wheat, you exchange it for 100 kg of wheat. Similarly, the selling of barley for barley is riba except if it is from hand to hand and equal in amount. And dates for dates is riba except if it is from hand to hand and equal in amount. So we can see that spot-based transactions are permissible in Islam in many senses. And this is relevant in deriving many of the rulings and models that we will see later on. It says in hadith number 2312, narrated Abu Sa'id al-Khudri radiallahu ta'ala anhu, once Bilal brought barney, a kind of dates, to the Prophet, peace be upon him. And the Prophet, peace be upon him, asked him, from where have you brought these? Bilal replied, I had some inferior type of dates and exchanged 2 sa'as, sa' being a unit of measurement, of it for 1 sa' of barney dates in order to give it to the Prophet to eat. Thereupon the Prophet, peace be upon him, said, beware, beware, this is definitely riba, this is definitely riba. Don't do so. But if you want to buy a superior kind of dates, sell the inferior kind of dates for money and then buy the superior kind of dates with that money. So we can see we're also being given the solution. When exchanging like for like items with differing quality, you can use a currency as a medium of exchange to go from one type of quality of dates or gold or anything to another. Next up, let's see where we have the prohibition of speculation, gambling, and gharar, which are ambiguous transactions. So in the Quran, in Surah number 5, verse number 90, it says, O believers, intoxicants, all kinds of alcoholic drinks, and gambling, and idols, and drawing lots for seeking luck or decision are an abomination of Satan's handiwork. So avoid strictly all that abomination in order that you may be successful. So drawing lots and all these types of gambling that involve luck or seeking decision like rolling dice, etc., these are considered an abomination of Satan's handiwork and are prohibited. Likewise, we find in Sahih Muslim, hadith number 1513, Abu Huraira radiallahu ta'ala anhu reported that Allah's Messenger, peace be upon him, forbade a transaction determined by throwing stones and the type which involves some uncertainty. So transactions involving speculation, gambling, uncertainty, ambiguity, all of these are prohibited within Islam. Transactions need to be clearly defined beforehand on what they represent, what's going to happen within the transaction, the responsibilities and rights of both parties involved. Next up, let's cover the prohibition of short selling. Short selling being, of course, where you sell something before you own it. And this is something which is found in many modern day financial transactions. So it is narrated in many different ahadith. Hakim ibn Hizam radiallahu ta'ala anhu said, "O Messenger of Allah, people come to me wanting to buy something that I do not possess. Should I buy it for them from the marketplace?" He, being the Prophet, peace be upon him, said, "Do not sell that which you do not possess." Meaning you're not allowed to sell something to someone that you don't possess, go and buy it later, and then give it to them. You can only sell which you already own and possess. Likewise, it is narrated in Sahih al-Bukhari, hadith number 2132, narrated Tawus, radiallahu ta'ala anhu. Ibn Abbas radiallahu ta'ala anhu said, Allah's Messenger, peace be upon him, forbade the selling of foodstuff before its measuring and transferring into one's possession. I asked Ibn Abbas, "How is that?" Ibn Abbas replied, "It will be just like selling money for money, as the foodstuff has not been handed over to the first purchaser who is the present seller." So we can see that short selling, selling that which you do not own yet, is prohibited in Islam. Now let's talk about things and financial transactions which are permitted in Islam. So the permissibility of trade. We find in the Quran, in Surah number 2, verse number 275, "Those who consume interest will stand on judgment day like those driven to madness by Satan's touch. That is because they say, trade is no different than interest, but Allah has permitted trading and forbidden interest." And there's an interesting parallel here, because in many Muslim countries, commercial banks or conventional banks don't write interest on their bank statements. They call it profit, trying to draw a parallel that it is not interest, but it is rather trading. So it is interesting that this is already pointed out in the Quran in this verse. "Whoever refrains after having received warning from their Lord may keep their previous gains, and their case is left to Allah. As for those who persist, it is they who will be the residents of the fire, they will be there forever." Once again, in this verse we find a severe prohibition over riba or interest, but we find that trading is permitted, where you buy something for a lower price and sell it at a higher price. Next up, let's talk about the fact that business partnerships, such as two people entering into a business together and sharing the profits, are permissible in Islam. So this verse in the Quran, in Surah number 38, verse 24, is taken from the middle of a story about Prophet Dawud alayhi salam, also known as David. In this particular story, two people came to him asking for a ruling about a dispute that they have. And within that story, we find this verse. David eventually ruled, "He has definitely wronged you in demanding to add your sheep to his. And certainly many partners wrong each other, except those who believe and do good, but how few they are." Then David realized that we had tested him, so he asked for his Lord's forgiveness, fell down in prostration, and turned to him in repentance. So the reason he asked for forgiveness in the end is because he gave the ruling after only hearing one party's side of the story and not hearing the other party. But what is of interest to us right now is this fact that he mentions there are many partners that do business, and the best of them are those who believe and do good. So from this verse, the scholars derive that partnerships are allowed in Islam. Obviously, there are other sources for the permissibility of partnerships as well, as we'll see later on. This includes sources which mention the permissibility of Mudarabah, which is a business partnership where one party puts in the money and the capital, and the other party puts in their expertise and the hard work, and then they share the profits. So it is reported in Sunan an-Nasa'i, hadith number 3928. Ibn On radiallahu ta'ala anhu said, Muhammad, peace be upon him, used to say, "In my view, land is like the wealth put into a Mudarabah, a limited partnership contract. Whatever is valid with regard to the wealth put into a Mudarabah partnership is valid with regard to land. and whatever is not valid with regard to the wealth put into a Mudarabah partnership, then it is not valid with regard to land. He said he did not see anything wrong with giving all of his land to the plowman on the basis that he would work with it himself or with his children and helpers and oxen, and that he would not spend anything on it. All expenses were to be paid by the owner of the land. So we can see in this Ahadith that they're mentioning a scenario where one person is the owner of land and he provides the capital and the land, and another party works the fields and grows the crops, and then they share the profits. And that's basically what a Mudarabah partnership is. And we'll see this model is used in modern day Islamic finance when we cover these models in more detail in the next section. Then there's the permissibility of renting land and by consequence other assets for money. So it is narrated in Sahih al-Bukhari, Hadith number 2722. Narrated Rafi bin Khadij, radiyallahu ta'ala anhu. We used to work on the fields more than the other Ansar, and we used to rent the land for the yield of a specific portion of it. But sometimes that portion or the rest of the land did not give any yield. So we were forbidden by the Prophet, peace be upon him, to follow such a system. But we were allowed to rent the land for money. Next up, let's talk about the permissibility of credit sales and purchases, meaning a sale or a purchase where you get the good or service right now, but make the payment later on, or receive the payment later on. And the use of collateral. So if, for example, you buy something on credit, you give the other party an asset in the meanwhile as collateral. In case you don't make the payment to them later on, they can use that collateral, sell it, and recoup their funds in that manner. So it is narrated in Sahih Muslim, Hadith number 1603. It was narrated that Aisha radiallahu ta'ala anha said, the Messenger of Allah, peace and blessings of Allah be upon him, bought some food on credit from a Jew, and he gave him a shield of his as collateral. So we can see the Prophet, peace be upon him, bought food on credit from a Jewish individual, and he gave him his shield as collateral until he would make the payment later on. Next up, let's look at the fact that money can be exchanged in spot transactions. So it is narrated in Sahih al-Bukhari, Hadith numbers 2060 and 2061. Narrated Abu al-Minhal, I used to practice money exchange, and I asked Zayd bin Arqam about it. And he narrated that the Prophet said in the following, and then he's mentioned other narrators, like Abu al-Minhal said, I asked al-Bara bin Azib and Zayd bin Arqam about practicing money exchange. Then we come to the crux of the hadith. They replied, we were traders in the time of Allah's Messenger, peace be upon him, and asked Allah's Messenger, peace be upon him, about money exchange. He replied, if it is from hand to hand, there is no harm in it, otherwise it is not permissible. Once again, we see the expression hand to hand, meaning a spot-based transaction. Meaning you can exchange different types of currency, gold for silver, gold for dollars, gold for cryptocurrency, dollars for cryptocurrency, dollars for silver, and the like. But any currency exchange, any money exchange needs to be on the spot, in spot-based transactions. So obviously forward contracts or future contracts are not permissible. Next up, let's look at the fact that sales in which a price is paid for goods to be delivered later, also known as Salam, which we'll see later on when we cover Islamic finance models, is also permissible. So we already saw that credit sales and purchases are permissible, meaning you sell something and receive the payment later. Now we have a situation where the payment is received first and then the good and service is supplied later. So it is narrated in Sahih al-Bukhari, Hadith number 2240. Narrated Ibn Abbas radiallahu ta'ala anhu. The Prophet, peace be upon him, came to Medina, and the people used to pay in advance the price of dates to be delivered within 2 or 3 years. He said to them, whoever pays in advance the price of a thing to be delivered later should pay it for a specified measure at a specified rate for a specified period. So in this hadith, we see once again that ambiguous transactions involving uncertainty about the future, are not permissible. If you are going to have a transaction where you pay now and receive something later, you need to specify those things, specify the measure, specify the weight, specify the time frame, and so on. And we will look at these conditions in much more detail in the next section where we cover the Salam Islamic model. Next up, and arguably one of the most important rulings, honesty and transparency in business, which should be relevant not just in Islamic finance but in all of finance. So it is narrated in Sahih al-Bukhari, Hadith number 2079. Narrated Hakim bin Hizam, radiallahu ta'ala anhu, Allah's Messenger, peace be upon him, said, the seller and the buyer have the right to keep or return goods as long as they have not parted or till they part. And if both the parties spoke the truth and described the defects and the qualities of the goods, then they would be blessed in their transaction. And if they told lies or hid something, then the blessings of their transaction would be lost. So a lot of people tend to isolate financial transactions and look at them in a vacuum, ignoring certain morality with it. But here we can clearly see basic honesty and transparency is a core part of Islamic finance and business in Islam. So if we were to summarize what we just covered, first let's start by what is permissible in Islamic finance. So we saw that trade is permissible. That means buying, selling any halal goods and services with the aim of making a profit. And we will see later on this includes Islamic financial models such as Murabahah and Musawamah. Then spot exchange of currencies is allowed. This includes gold, silver, paper currency, and cryptocurrency. The sale where you make the payment in advance and supply the goods and services is allowed as well. This was basically the Salam contract. But this must be on actual goods and products with clearly defined details such as the price, quantity, and time frame. Sales with deferred payments are also allowed, where you receive the item or service right now and make the payment later. But again, they must be on actual goods and products with the price already set, and there can be no penalties for late payment. Partnerships are allowed. This includes different kinds of business partnerships where one person provides capital or both people provide capital, one person provides expertise or both people provide expertise, and so on. And this includes Islamic finance models such as Musharakkah and Mudarabah, which we'll look at later on. Renting of assets is also allowed. This includes Islamic finance models such as Ijarah. And then the order to manufacture assets or make assets, that you place an order, make something that will take some time, and then you pay for it once it is constructed. This is also allowed. This includes the Islamic finance model of Istisna. Basically, you can place an order to manufacture an asset with pre-agreed terms of the price, delivery, time frame, and payment can be in advance, in installments, or later on once the construction of the asset is completed. So we will see that this summary represents a lot of what we will cover in the main models used within modern day Islamic finance. Likewise, if we were to summarize what is prohibited in Islamic finance, obviously we'll start with Riba. This includes receiving interest, paying interest, recording interest, or facilitating an interest-based transaction. It includes modern day financial instruments and transactions such as conventional loans or bonds. Likewise, ambiguous transactions are prohibited. So these are transactions where the terms are not clearly defined or agreed upon. So too is speculation and gambling. So any transactions which are dependent on uncertain future outcomes are prohibited. This includes modern day financial transactions such as derivatives, options, and conventional insurance. Then it is prohibited to have a delayed exchange of currencies. Currencies must be exchanged on the spot. This includes all types of currencies, paper currency, crypto, gold, and silver. And obviously that means forwards and futures contracts with these currencies are prohibited. Likewise, short selling is prohibited. So you cannot sell what you do not own and possess. So now that we have a general idea on most things which are permitted in Islamic finance and most things which are prohibited in Islamic finance, and we have seen how they are derived directly from Quranic verses or authentic Ahadith, we can now get a better appreciation of the modern day Islamic finance models which are used. And that's what we're going to cover in this next section. So in this section, we're going to look at the most commonly used and most popular Islamic finance models which cover the overwhelming majority of what is used in the Islamic banking industry. So we've seen what the Quran and the Sahih Ahadith say about what is permissible and what is prohibited. Now we're going to look at the commonly used Islamic finance models and how they are applied by Islamic banks in their actual sense. So if we were to break down the most commonly used Islamic finance models, we have Musharakkah, Mudarabah, Ijarah, Murabahah, Musawamah, Istisna, and Salam. Now, broadly speaking, we can break these down into two main categories. There's the ideal forms of models, which mainly include Musharakkah and Mudarabah. Ijarah, you can argue one way or the other. But these are considered ideal because these are partnerships which result in risks and rewards being shared between all parties. And that is the ideal form of Islamic finance because it results in a more equitable distribution of wealth. And then we have the other models. These are not bad per se, but in an ideal setting, an Islamic bank should primarily focus on financing arrangements and investing arrangements through Musharakkah and Mudarabah, and only resort to these other models if that option is not viable. So let's go through these one by one, understand what they are in theory, how Islamic banks apply them, whether there are certain conditions that need to be met, and so on. So we're going to start with Musharakkah. So Musharakkah means sharing in Arabic. In the context of Islamic finance, it refers to the sharing of ownership, risk, profits, and losses. It is basically a business partnership or co-ownership of an asset. So either multiple people own a business together and then they share the profits and losses of that business, or they own an asset together, and again, if that asset is being used for financial purposes, they share the profits or losses of that asset. So let's say A and B collectively own AB Co. This is an example of what is called Shirkatul Aqd, which is a type of Musharakkah. If A and B own an actual asset, let's say a house, they're co-owners, they're joint owners, then this is known as Shirkatul Milk. So if you co-own a business, it's Shirkatul Aqd. If you co-own an asset, it's Shirkatul Milk. Now, there are certain conditions that come with a Musharakkah partnership. Firstly, in a Musharakkah, losses are shared in proportion to the capital invested. For example, let's say two individuals want to start a business. They invest the capital. The first person invests 60,000 rupees, the second person invests 40,000 rupees. That means the total partnership has capital of 100,000. Meaning the share of each individual, the one who invested 60,000 rupees is 60%, and the one who invested 40,000 rupees is 40%. Now, let's say in the upcoming period, the partnership makes a loss of 20,000. This will be split according to the ownership shares. So, 20,000 into 60%, the first person will have a loss of 12,000. And 20,000 into 40%, the other person will have a loss of 8,000. So, simply, losses are shared in proportion to the capital that was invested. But as for profits, there is a difference of opinion, whether they should be shared based on the capital invested, just like the losses, or at mutual, pre-agreed terms between the partners. The more widespread opinion is the latter, and there's a reason for this. So yes, it makes sense that you share profits based on the same ownership percentage, just like you do losses. It seems fair. But if you think about it, businesses or partnerships are more than just the capital invested. For instance, in our example over here, let's say the person who invested 40,000 rupees, even though he owns 40% of the business, he puts in twice the hours of work compared to the person who owns 60%. Is it fair then that they have a split of 60% to 40% profit sharing when the person with 40% ownership is putting far more effort into the business? Doesn't seem fair. And that's why the more widespread opinion among scholars is that you can have different percentages of profit sharing from the amount that was invested as capital, but it must be mutually pre-agreed. For example, if both parties agree that 50% of the profits are yours and 50% of the profits are yours, then that's fine. They have to have that in the agreement, in the contract, and then they can work on that basis. The losses will still be split 60% to 40%. And the reasons the losses have to be split in proportion of ownership is because if you think about it, the capital invested is what you stand to lose. So if you put in 100,000, ultimately if you lose everything, the person who invested 60,000 will lose 60,000, and the person who invested 40,000 will lose 40,000. So the loss distribution will ultimately end up being 60% to 40%. So let's see how Musharakkah is applied by Islamic banks in real life. So we have an example from Mizan Bank, which is one of the main Islamic banks found in Pakistan. And this excerpt is taken from their website. So they have a financing facility for the service industry. So on their website, it says running Musharakkah. This is a Shirkatul Aqd. Remember what we said? Shirkatul Aqd is when the parties co-own a business. So they say this is a Shirkatul Aqd based financing facility offered to the customers where the bank participates in the operating activities of the customer and shares profit and loss as per the actual performance of the business. This product is also used as a viable financing solution for service industry and travel agents whose financing needs are generally not addressed by other asset-backed products. So in the service industry, typically the company does not own many assets. Their main asset is their workers who are providing the service. So something like a Shirkatul Mix might not always be viable. That's why the bank offers financing through Shirkatul Aqd. What would basically happen is, for example, a service company comes to the bank and says, we need money for this particular project. The bank will invest that money into the project, so they'll provide the financing, and the company will work on that project, and any returns from the project will then be split between the bank and the service company. And of course, this must be on the pre-agreed profit percentages that were decided before going into business together. Now, there is another important variation of Musharakkah that we need to know about, and that is called a diminishing Musharakkah. So a diminishing Musharakkah is a partnership in which one of the partners promises to buy the share of the other over time, until the title to the equity or asset is completely transferred to him. So basically, it's one partner buying out another partner, whether it be for a business, whether it be for an asset. And this becomes very useful in Islamic banking and finance because typically you don't want to have a continuous ongoing business with every single person you're providing financing to. So you give the other party an option to buy out your share over time. But of course, there are certain conditions that need to be met. So firstly, this buying and selling should not be stipulated in the partnership contract. So you mustn't enter into this partnership agreement already with the notion that eventually one party is going to buy out the other. The partnership contract is separate and independent. The buying of shares later on is independent and separate from that contract. In addition, the buying and selling agreement must be independent of the partnership contract, like we just said. It is not permitted that one contract be entered into as condition for concluding the other. So you can't say, I'm only entering into a partnership with you if I buy your shares or if you buy my shares at the end of the partnership. And shares repurchased can be priced at the fair market value of the asset or the business at that particular point in time when a purchase is taking place. Or it could be a pre-agreed price. You have flexibility in that regard. And this model of diminishing Musharakkah, as we'll see later on, can be combined with other Islamic finance models such as Ijarah. For now, let's move on to the other type of partnership, which is Mudarabah. So Mudarabah is a partnership in profit whereby one party provides the capital, and this party is called the Rabul Mal, and the other party provides the labor, and they're called the Mudarib. Basically, think of it this way. Someone has money and they want to start a software company, but they don't know anything about coding. So they hire an expert coder and they enter into an agreement. The coder will work and make software, and the investor will provide money. And together, whatever they earn from this partnership, they will split the profits. So you have two parties, the Rabul Mal, the financier, and the Mudarib, the worker or the expert. So the Rabul Mal will put in the entire capital, in this case, let's say 100,000 rupees. The Mudarib will contribute no capital, but will contribute labor and time and effort. So together they form a partnership with a capital of 100,000 rupees, entirely contributed by the Rabul Mal. This is typically used in Islamic investment banking, where the investor or the person who wants to make a return is the Rabul Mal, and the Islamic bank or asset management company is the Mudarib. They're going to use their expertise in finance to try to generate returns from that investment capital. So just like you invest in a mutual fund or a savings account. In Islamic banking, you'll do it with an Islamic investment bank. You'll put your money into the savings account or into the fund, and the bank will then use all that money and try to use their financial expertise to earn a return by investing that money in different places. So you are the Rabul Mal because you entirely provided the capital, and the bank is the Mudarib because they just provided their expertise, and then you share the profits amongst yourselves. Just like with the Musharakkah, a Mudarabah has conditions as well. So firstly, the amount of the capital must be clearly known. Like we said, you can't have ambiguity or uncertainty in transactions. You need to clearly stipulate that this is the capital. What's more, the capital should be in the form of currency, because then it's easily accountable. Financial losses are borne by the Rabul Mal, the financier. Obviously, since only the Rabul Mal is putting in money, only they stand to lose money. So in the event of a loss, they're the only one who loses money. The Mudarib only loses the time and effort that they put into the business. At the same time, the Mudarib cannot be paid a salary. This is important. Imagine the Rabul Mal puts in all that money and the business goes into a complete loss. The Mudarib still earns the salary, still earns the return. And you have a situation of this partnership where one party made a lot of money because they were constantly paid a salary and the other party lost everything. Obviously, that's not fair at all. The Mudarib cannot be paid a fixed salary. Their return is in the form of profits. So the profit should be shared between the worker, the Mudarib, and the financier, the Rabul Mal, according to a pre-agreed ratio. Once again, you need to clearly define what the profit sharing ratio is beforehand. The Mudarabah contract should be free of restrictions, for example, trading only in a specific country, product, or time. In other words, the Rabul Mal cannot handcuff the Mudarib and say, you can only trade in this country or you can only trade in this product. You need to give them flexibility and freedom so that they can use their expertise to their full potential to earn a profit. So let's see how real-life Islamic banks apply the Mudarabah model. Once again, we take this from the Mizan Bank website. This time, we're going to talk about their savings accounts, which are based on Mudarabah. So they say on their website, on agreeing to become a freelancer account holder, the customer enters into a relationship based on Mudarabah with Mizan Bank. Under this relationship, the customer is an investor, Rabul Mal, because you are putting your savings, you're putting the capital in, and the manager, Mudarib of the funds deposited by the customer. So the bank manager or whoever's managing these funds is the Mudarib. They're going to use their financial expertise to invest these funds and try to earn a return. The bank allocates the funds received from the customers to a deposit pool. Funds from the pool are utilized to provide financing to customers under Islamic modes that include but are not restricted to Murabahah, Ijarah, Istisna, and diminishing Musharakkah. So basically, they'll collect all this money from all these savings accounts and then they'll invest it, typically through financing arrangements to customers who are borrowing money from the bank. So they'll get a return from these customers and then they'll share that return with the Rabul Mal, who are the investors in their savings accounts. Up next, let's talk about Ijarah. So Ijarah means to rent. In Islamic finance, it is a leasing arrangement where rental payments are collected on an asset as a form of return. So this is important because, like we said, Islamic finance is not just about variable returns or fixed returns. You can have both. Yes, ideally you want a partnership where the risks and rewards are equitably distributed. But that is not the only form that is permissible. Yes, you can have situations where you earn fixed returns. And one of the foremost models that you can use for that purpose is Ijarah. You can earn fixed rental returns rather than fixed interest returns. So this is commonly used as a substitute to conventional loans in order to provide asset financing. So the difference is, in Ijarah, there is an underlying asset, something of actual value that is earning that income, as opposed to a conventional interest loan where the money is earning money on top of itself. So to contrast conventional loans with Ijarah agreements, let's look at an example. In a conventional loan, let's say a farmer tells the bank, I need to buy a tractor for my business. So the bank gives a loan to the farmer. The farmer uses that money to buy the tractor, and then the farmer pays the bank interest payments on that loan and eventually pays back the principal of the loan as well. In an Islamic bank, Under an Ijarah agreement, the farmer tells the bank, I need to buy a tractor for my business. The bank goes and purchases a tractor, and then they rent the tractor to the farmer. And the farmer makes rental payments to the bank. In some cases, there might be a clause in the agreement that allows the farmer to buy the tractor at the end of the term of the agreement. But in a standard Ijarah, typically it just ends with the farmer making rental payments for as long as he needs to use the asset, and the asset remains in the bank's ownership, and then they can rent it out to someone else or sell it, whatever they see fit. So let's see how Ijarah is applied by real-life Islamic banks. So once again, we go to Mizan Bank's website. They provide asset financing through Ijarah. So it says on their website, Mizan Bank provides Ijarah-based products to provide flexible solution for meeting long-term financing requirements of the customers. Ijarah technically means to give something on rent. The bank uses this product for medium and long-term financing purposes, where the bank acquires the asset required by the customer and then leases it to the customer for a fixed period. This product is used for the financing of assets such as plant, machinery, generators, equipment, etc. So the reason most of these examples are from Mizan Bank is because their website very clearly states not just what these models are, but how they're using them. So it's very convenient for people to understand, and hopefully you guys get a better picture, not only of how these models apply in theory, but that Islamic banks are actually using these models for these particular purposes. Up next, we're going to talk of a different variation of this model, which is Ijarah based on diminishing Musharakkah. So now we're combining two models, Ijarah, which is a lease agreement, a rental agreement, and Musharakkah, which is a partnership. Diminishing Musharakkah, like we saw, is a partnership where one party eventually buys out the other party. So let's see how this works. So under this model, two parties jointly purchase an asset. One party then leases its share of the asset to the other party for their use. So just like we saw in the previous example, the farmer needs a tractor. In this case, both the farmer and the bank will contribute to buying the tractor. So they'll own a certain percentage each. And then the bank will lease its share of the tractor to the farmer. Basically, the farmer will get to use the tractor, and they'll pay rent on the tractor to the bank for their percentage ownership of that tractor. The lessee pays rental payments to the lessor for using their share of the asset, like we said. The lessee also periodically buys portions of the lessor's share of the asset. Rent is adjusted accordingly. So over time, the farmer also makes payments to buy parts of the tractor from the bank. So maybe if the bank starts with 60% share, the farmer buys 10% share every month by making a payment to buy that share from the bank. And by the end of the agreement, he owns 100% of the tractor and no longer has to make any rental payments. Obviously, the more share he acquires, the lower the rent he'll have to pay for the remaining share. Once the lessee has entirely purchased the lessor's share, they become the sole owner of the asset. So let's look at an illustration for Ijarah based on diminishing Musharakkah. Let's put some numbers to it so that you can better understand how this works. So let's say you have the lessee, the client, who's going to borrow money from the bank, and the lessor, who is the bank. So the lessee wants to buy a fancy car. So both the lessee and the bank will put in money into the car. The lessee has only 20 million rupees. So the lessor, the bank, will provide, let's say, the remaining 80 million rupees. And together they buy this car. So the lessee put in capital of 20 million. The lessor put in capital of 80 million. That means the lessee's stake in the car is 20%. And the lessor, the bank's stake in the car, is 80%. Then the bank will rent out the car to the lessee, basically their 80% of the car to the lessee. In other words, the lessee gets to use the car as he wants, but he has to pay rental payments for this 80% that the bank owns. Let's say they determine that this rent amount is 2 million per month. Now, over time, the lessee is given an option under Ijarah based on diminishing Musharakkah to buy off from the 80% share of the bank. So he will start paying a purchase price for shares of the asset to the lessor or the bank. So let's say he agrees to buy in pieces of 20 million at a time. So after a few months, he makes a 20 million rupee payment to the bank. Now the lessee's share is 40 million, and the bank's share has gone from 80 million down to 60 million, meaning the lessee owns 40% of the car and the lessor, the bank, owns 60%. The rent will be adjusted accordingly. It went from 80% to 60% ownership, so it will go from 2 million to 1.5 million, which is 3/4, just like 60% is 3/4 of 80%. And the total purchase payment made so far from the client to the bank is 20 million. Then let's say after a few months, another share of 20 million is purchased. So the lessee, the client, now has 60 million invested into the car, and because he bought 20 million more from the bank's share has gone from 60 million down to 40 million, meaning that the client now owns 60%, the bank owns 40%. Once again, the rent will be adjusted accordingly as well. Now the bank's share has gone from 80% down to 60% down to half, which is 40%. So the rent would have been half too. So from 2 million, it's gone down to 1 million per month. And now the total purchase price payment has been 40 million across these two payments. And then let's say at the end, after a few months, the client has enough money to buy off this remaining 40 million that the bank has. So now they make a payment of 40 million, and now they've invested a total of 100 million into the car. The bank is left with no share. So the lessee is 100% owner. The bank is no longer part owner. There's no more rent involved. And the lessee has invested an additional 80 million on top of the original 20 million to pay the full 100 million for the car. And at this point, the lessee or the client now is the owner of the car. So this is how an Ijarah based on diminishing Musharakkah works. The bank makes a return based on rental payments it collects in the meanwhile, while the lessee is given a time frame to acquire the asset over a period of time before eventually becoming the owner. Once again, let's see how this is applied in real life by banks. So Mizan Bank has an asset financing model through Ijarah based on diminishing Musharakkah. So it says, this is a medium and long-term financing product where the bank and the customer jointly purchase an asset and create joint ownership in the asset, meaning it's a Musharakkah, specifically a shirkat or milk, because it's joint ownership of an asset rather than a business. The bank then leases its share in the asset to the customer, while the customer purchases units of ownership in the asset from the bank at periodical intervals. So just like we saw in our example, because the bank is leasing its share in the asset to the customer and the customer is making rental payments, it's an Ijarah. But because the customer can purchase units of ownership from the bank over a period of time, it's a diminishing Musharakkah as well. Upon purchase of all the units, the customer becomes the owner of the asset. This mode is used for financing of fixed assets such as land, factory, building, etc. After this, let's look at the next model, which is Murabahah. So Murabahah is a sale transaction where the seller discloses both the cost and selling price to the buyer. So if the seller tells the buyer, I bought this thing for 100 rupees, but I'm going to sell it to you for 120 rupees, that sort of sale is basically a Murabahah. In Islamic finance, it is generally used as a form of financing assets or inventory. It must follow specific steps and conditions in order for the transaction to be Sharia compliant. So again, there need to be specific steps followed for the transaction to be allowed under the Sharia. So let's look at an illustration so that we can understand these steps. Let's say that a trader tells the bank about the products he wants to acquire, right? So he wants to buy certain products, certain inventory. He doesn't have the money, so he goes to the bank. The bank will either buy these products for itself, or they will appoint the trader as the agent to buy the products on their behalf. So if they don't know much about the market, they'll tell the trader, okay, you're our agent, here's the money, buy the products on our behalf, or either they'll go and buy the products themselves. So after this, the bank has purchased these products. Let's say their value is 100,000 rupees. The bank takes possession of the products because remember, you cannot sell that which you do not own or possess. The bank then sells the products to the trader at a higher price after taking possession of them. So the bank needs to make money off of this. So they sell the products to the trader for, let's say, 120,000 rupees. So the trader knows that they bought it for 100,000 and then they sold it to him for 120,000. That's why it's a Murabahah. So now the item is delivered to the trader and he is now owner and he needs to pay the 120,000 to the bank. The payment can be on the spot, it could be delayed, or it could be in installments, right? So there's flexibility in that regard. However, there can be no penalty for late payments, and the price that was agreed cannot be changed, otherwise it would be like Riba. So the price has to remain 120,000, and if the trader is late in making a payment, the bank cannot charge him extra, like conventional banks do, that if you're late in making a payment, you have to pay extra interest. Now one might say, but that gives the trader an opportunity to exploit this and not make the payment until much, much later. So there is a way around this. What the scholar says, yes, you cannot charge a penalty to the trader for late payment so that you collect the money, but you could put a stipulation in that if the trader is late in making the payment, he has to pay a certain amount of money to charity. So in that way, you can force the trader to make sure that he pays on time, but you don't get to earn that extra money. Once the bank has sold the products to the trader, he can sell them in the marketplace so long as it is to someone who has no connection to the bank or the dealer who sold them to the bank. So you cannot use this transaction to try to mask a more complex transaction where all the parties are colluding together to try to make something work out and to circumvent or navigate around these rules. It has to be independent. The trader and the bank have their own transaction, the bank and the dealer have their own transaction, and then the trader, once he gets the goods, he has to go on and do his own independent business. He shouldn't have anything to do with the bank. So the trader will find a customer and then sell it to them. It is stipulated that the trader sell them himself. He cannot delegate the responsibility to the bank. Because otherwise what will happen is all these parties can collude together and try to use Murabahah and say that this is all Sharia compliant, but they're actually just doing a Riba-based transaction with a Murabahah facade. So these conditions must be followed for a Murabahah to be Sharia compliant. So again, let's look at how real-life Islamic banks use Murabahah. So Mizan Bank provides inventory financing through Murabahah. So on their website, they've mentioned, Mizan Bank offers a convenient and easy-to-use solution for financing raw material and inventory requirements to the customer through Islamic mode of Murabahah. Once again, they've mentioned what Murabahah is. They say Murabahah is a sale transaction where the seller discloses the cost and profit to the buyer at the time of execution of sale. Murabahah is a short-term Islamic facility for meeting asset-based working capital requirements of customers, where instead of providing a loan, Mizan Bank sells the required asset to the customer on a spot or deferred basis. So it's basically what we just described. Up next, let's look at a similar model, which is the Musawamah model. So Musawamah describes a transaction where the cost of the good or service is not disclosed to the buyer. So Murabahah was a sale where the cost and the selling price are both disclosed to the buyer. You tell them how much you bought the asset for and how much you're selling it to them for. Musawamah is like your standard sale transaction. You are not told what the person bought it for. They're just telling you this is the price. Do you want to buy it or not? Right? When you go to the supermarket to buy some juice, the supermarket doesn't tell you, oh, I bought this juice for this much, but I'm selling it to you for this much. No, they just tell you this is the price, and if you want to buy it, you buy it. This differs from Murabahah transactions, obviously, because the buyer knows the cost of the underlying asset in a Murabahah. And in a Musawamah, the seller is not obligated to disclose the cost. The selling price is whatever is negotiated between the buyer and seller. Musawamah is also generally used as an underlying model for asset or inventory financing arrangements. So both Murabahah and Musawamah usually have similar uses. So once again, if we see how Islamic banks apply this, Mizan Bank provides import financing through Musawamah. So it says Mizan Bank offers flexible and convenient import financing facility on the basis of Musawamah/Murabahah. Because again, they're effectively the same thing, only in one case you're being told the cost as well as the price, whereas in one case you're just being told the price. If the customer wants to finance its letter of credit, the bank appoints the customer as its agent to import the goods, and customer establishes the LC as an agent of the bank. Upon receiving possession of the goods, the bank sells the goods to the customer on a deferred payment basis. Right? So the rest is not that relevant, but basically they provide import financing through Musawamah. In other words, the bank will just buy those imported goods and then sell it on to the customer at a profit margin so that they can make a return from this transaction as well. Then we have Istisna. Istisna is a sale transaction between a buyer, the Mustasni, and the seller/manufacturer, the Sani. So Istisna specifically has to do with the sale of assets which need time to be manufactured or made. For example, houses. So the customer, the buyer, approaches the manufacturer, the seller, to construct a specified asset for him. For example, a house. This is going to take some time, obviously. They agree on the specifications of the asset, the price, and the date of delivery at the time of contract execution. Once again, you need to be clear on all the details of the contract beforehand. There cannot be any ambiguity. The customer pays the price to manufacturer upfront or in installments based on their agreement. So typically there's some amount paid upfront so that the manufacturer can use that money to actually make the asset. And then some amounts are paid in installments, but there's flexibility in that regard. After the asset is completed, meaning after the house is made, the manufacturer delivers it to the customer on the delivery date. So Istisna is typically used for manufacturing of houses or other long-term assets. You also have parallel Istisna, where multiple Istisna contracts are entered at the same time. The parallel Istisna contract involves three parties and it consists of two separate Istisna contracts. So let's say the customer wants to purchase an asset, for example a house, and approaches the Islamic bank for financing because they don't have enough money on their own. So the customer and the bank enter into the first Istisna contract. The Islamic bank is going to be the seller in this contract and the customer is going to be the buyer. So let's call this Istisna contract A. Customer, buyer, Islamic bank, the seller. Now the price is determined as the bank's cost plus profit margin. So the bank tells the customer this is how much you need to pay us. Then the Islamic bank will enter into a second Istisna contract because obviously the Islamic bank cannot construct houses, that's not their expertise. So they'll go find an actual manufacturer who does make houses. And in this second Istisna contract, the Islamic bank will be the buyer and the contractor, the manufacturer, will be the seller. So this will be Istisna contract B, in which the Islamic bank is the buyer and the contractor is the seller. So effectively, just because the customer wants financing, the Islamic bank becomes a middleman between them and the contractor. If the customer already had money, they would just enter the Istisna contract directly with the contractor and have it done without the Islamic bank's involvement. But because they need financing, they need to involve the bank as a middleman. So the Islamic bank will then pay the cost of construction to the contractor, let's say 9 million. The contractor will start making the house. After the house is completed, the customer is given ownership. And the customer then has to pay the price of the house to the Islamic bank. Typically it's in the form of installments, though it could be lump sum, as per whatever was agreed in their initial agreement. So let's say ultimately he ends up paying them 12 million. So the bank makes 3 million off of this whole transaction. The contractor makes 9 million and the customer gets his house. So let's see how Islamic banks apply this in real life. So Mizan Bank has a working capital financing arrangement with Istisna. So on their website it says Mizan Bank offers an Istisna-based solution to finance complete working capital requirements of its customers. Istisna is a type of sale transaction where the buyer places an order with the seller to manufacture a certain asset and the sale is completed upon delivery of the asset to the buyer. Under this facility, Mizan Bank provides funds to customers for manufacturing certain assets for the bank and then upon delivery sells the assets to the market. So Mizan Bank is specifically using this facility as a form of profit generation through selling these assets. So customers who need money to make these assets go to the bank for financing, the bank provides them financing, they make the asset, the bank sells the asset in the market and the bank makes a profit that way. Next up, let's look at the Salam Islamic financing model. So we already went through this hadith in the previous section, but we'll go through it again just as a refresher. So it was narrated by Ibn Abbas radiallahu ta'ala anhu. The Prophet, peace be upon him, came to Medina and the people used to pay in advance the price of dates to be delivered within 2 or 3 years. He said to them, whoever pays in advance the price of a thing to be delivered later should pay it for a specified measure at specified rate for a specified period. This is basically what a Salam agreement is. And it is a specialized form of agreement. So just like Istisna was specialized to cater to manufactured assets that take a time to manufacture, Salam typically involves commodities, more specifically agricultural produce. because this produce takes some time to grow, and once it has grown, it is perishable, so it needs to be sold quickly. So there's a special type of transaction, which is Salam, which is used to make sure that the farmer can sell his produce quickly and that the people who need it can get it quickly on a specified date with the specified requirements. So Salam is a sale of a prescribed commodity for deferred delivery in exchange for immediate payment of the price. So payment is made in advance, and once the crops have grown and have been harvested, they are delivered. This is commonly used in areas such as agricultural financing. So it's more specific to this particular industry. Like with Istisna, you can have parallel Salam agreements. So how would those work? So after the execution of a Salam agreement with one party, the bank executes another contract with a third party, just like they did with the parallel Istisna. They must be two different and independent contracts, neither contingent on nor linked with each other. This is very important. These conditions must be met for these whole transactions to be Sharia compliant. So let's look at an illustration. So on 1st of April, the bank, the buyer, enters into a Salam contract with a farmer, who is the seller, and pays full payment in advance for the commodity, which will be delivered on 30th of June. So the farmer says, I'm growing crops, I have land, and they'll grow by 30th of June. I need some money so that I can make sure that the crops are grown properly. So he goes to the bank gives him that money, and the farmer promises that on 30th June, I will deliver these crops to you. So they enter the first Salam contract, let's say contract A. The farmer is the seller and the bank is the buyer. Now obviously the bank does not really need the crops. Let's say it's wheat. What is the bank going to do with hundreds of kg of wheat? So they're going to try to find someone who actually needs the wheat so that they can sell it to them. The problem is they cannot wait when the farmer delivers the wheat to then find a customer. Wheat is very perishable. They need to find a customer in advance so that as soon as the farmer delivers the wheat, they can then deliver it on to the customer. So they make an advance payment, let's say 10 million to the farmer, and they set about to find a customer. So let's say by 15th of April, the bank, now as a seller, enters into a parallel Salam contract with another party, a buyer, to sell the commodity and receives the full payment in advance for the commodity, which will be delivered on 1st of July. So they'll get the commodity from the farmer on 30th June, and the next day they'll deliver it to this customer. Let's say it's a restaurateur who needs it for his various restaurants to make their dishes. So this second Salam contract, let's say contract B, the bank is now the seller and the customer, the restaurateur, is the buyer. Remember, this must be entirely independent from the farmer's contract, and it cannot be contingent on the farmer's contract, meaning the bank cannot say that, oh, the farmer did not deliver me the wheat, so I can't deliver it to you. No, the bank has to fulfill this contract regardless of what happens with the farmer's contract. So the bank will receive payment in advance from the customer. Let's say they receive 12 million. So that's how they make the profit of 2 million from all these transactions. Then on the 30th of June, it's time for delivery. The commodity is delivered to the bank by the farmer. So he fulfills his contract and this contract is done. And then on 1st of July, the bank has to fulfill their obligation. So they deliver the commodity to the end customer. And in this way, both Salam contracts are settled. Now this is a complex transaction with different dates and different parties involved. And remember, in Islamic finance, the more complex a transaction, the higher the chance that something happens that puts it out of line with the Sharia requirements. So we always need to be careful with these sorts of transactions. And of course, there are many conditions that need to be fulfilled for this transaction to be in compliance with the Sharia. So let's look at these conditions. First of all, the buyer shall pay the price in full to the seller at the time of the sale. So the payment needs to be made in advance just because of the nature of the business. The farmer needs that money to grow that produce in the first place. The specifications, quality, and quantity of the commodity must be clearly determined beforehand. Once again, there shouldn't be ambiguity in the contract. Everything needs to be determined from the get-go. Time and place of delivery must be agreed, but can be changed with mutual consent of the parties. So if something doesn't go to plan, maybe due to rains or bad weather, the crop hasn't fully been harvested until the date of the contract, the two parties can mutually agree to change the date. But if one of the parties does not agree, then the other party is obligated to still fulfill that delivery requirement Even if they can't do it with their own crops, they need to find some substitute somewhere. The buyer cannot sell the goods until he takes possession. Now this is important because you'll think of the previous illustration and say, wait a second. Didn't the bank already enter into a parallel istisna well before they got the crops from the farmer? And that's true. That seems to contradict this particular condition. So keep this condition in mind. Let's look at the other conditions and then we'll circle around back to all of this and wrap everything together. Salam is used for sales of commodities which have homogeneous units. So homogeneous meaning they're similar. That one bag of wheat is pretty much the same as another bag of wheat as long as they're harvested from the same place, right? So you can have one bag, you can have two bags, you can have three bags, and they should all be identical more or less. And these are goods that are traded by counting, measuring, or weighing according to usage and customs of trade. Because they're homogeneous, you can replace one bag with another, you can add one bag and another bag to have two bags, and so on. Salam cannot be used to trade non-homogeneous things like pieces of jewelry which are unique. Salam cannot be used for things which must be delivered on the spot. So like we saw, currencies, gold, silver, paper currencies, cryptocurrency, all of these must be exchanged on the spot. And in this case, since there's a delay in delivery, these particular types of items, these currencies, cannot be used under a salam contract. Salam cannot be tied to the produce of a particular farm, field, or tree. This is very important. So in the previous illustration, the bank cannot say to the farmer that you must deliver the wheat that you grow on your own pieces of land. No, the obligation is that the farmer needs to deliver whatever, 200 kg of wheat to the bank by the 30th of June. Whether it's from his own land, whether it's from some other farmer's land, that doesn't matter to the bank. They're concerned with the wheat, and the farmer is concerned with providing the wheat from wherever he can get it. And the same applies to the bank's contract with the end customer. The bank cannot be told by the customer, I want the wheat that you bought from that particular farmer. The bank needs to just provide the wheat. Wherever they get the wheat from, the end customer should not care, and nor does he have any right to say where they get it from. In case of multiple commodities, so let's say the contract is not just for wheat, but also for apples and for oranges and for lemons and the like, the quantity and period of delivery for each of them should be determined separately because, again, these are different commodities. They'll have different harvest times, different conditions in their market, and so on and so forth. So you should enter separate clauses or separate agreements for each commodity. And finally, the important point to bring it all together, the buyer can enter into a parallel salam contract without any link with the original salam contract. Each of the two contracts shall be independent of the other. Parallel salam is only allowed with a third party. So a parallel salam or a parallel istisna for that matter, you cannot enter it with the same party that you entered the first agreement with. But more importantly, there cannot be links between the two contracts, whether it's parallel istisna or parallel salam. So when the bank entered the second salam contract with that restaurateur, the restaurateur doesn't need to know anything about the first contract. And the fulfillment of the first contract has nothing to do with the second contract. So if the farmer fails to deliver the wheat, the bank still needs to deliver the wheat the next day to the restaurateur. And this is how that condition that the buyer cannot sell goods until he takes possession is overcome. Because the goods that are being promised to the restaurateur in the second contract are not the goods that are being bought from the farmer. They can be any goods. The bank is just telling the restaurateur, on 1st of July, you're going to get this much wheat from us. Now, the fact that they end up using the wheat they got from the farmer has nothing to do with it. If the farmer didn't deliver, the bank would still have to find a way to get some wheat and deliver it to the restaurateur. So that's why the fourth condition, where we said the buyer cannot sell the goods until he takes possession, does not get contradicted in this particular situation. If there was just a one-off salam contract between the restaurateur and the bank, then obviously the bank would need to find the wheat first and then make the delivery. So as we saw, this is a complicated transaction, and remember what we said, that's why Musharakkah, Mudarabah are ideal forms of Islamic finance. Not only do they result in more equitable distribution of wealth, but they're more simple, they're more straightforward. There's not all this complexity with all these different delivery dates and all these different parties, where something can easily go wrong, something can easily contradict one of these conditions and the whole transaction is no longer Sharia compliant. That's why those are considered ideal forms of Islamic finance and these are not considered ideal forms of Islamic finance. But obviously if the conditions are followed, then yes, this will be Sharia compliant. So let's see how this form of financing is provided by Islamic banks in real life. We have some variety this time. This time we're going to look at an excerpt from HBL. It's a major bank in Pakistan that does provide Islamic banking as well. They provide agricultural financing through Salam. So from their website we have this excerpt. So an overview, a facility that caters to the working capital requirements of the agricultural sector and manufacturers, exporters of homogeneous commodities. Like we said, this has to do with homogeneous commodities and is primarily used by the agricultural sector. So features can be used by customers to finance overheads and utilities costs, ideal for agricultural financing needs, and the guiding principle is, it is a sale whereby the seller customer delivers specific goods to the buyer, the bank, at a future date in exchange for a price paid fully in advance. So just a description of the contract. Upon delivery of the goods to the bank appoints the customer as its agent to sell the goods in the market. Now, this condition again might have you raise an eyebrow that isn't the whole thing supposed to be independent, that after the sale is done, the bank needs to independently sell it to an independent party, different from the original seller. And yes, you can raise an eyebrow. Like we said, just because the bank calls itself Islamic does not mean it does everything perfectly. Now, their argument would be, well, the customer actually knows this market, so that's why we're asking him to sell in the market so that he can find a good buyer for us. But yeah, you can say ideally speaking, the customer should not be appointed the agent. There should be complete independence and the bank should make the end sale themselves. But that's a different discussion for a different matter. Here we're just talking about the fact that Islamic banks do use these models. How perfectly they apply them is a different matter entirely. So if we were to summarize all these different models we went through, because there's a lot of models, the good news is that these are the overwhelming majority of models used in Islamic banks. So if you know these, you're pretty much good to go. So let's summarize so that we can recap all that we just covered. So if we were to break down these different Islamic banking models, there's three broad types. There's partnerships, there's lease arrangements, and there's sales. So in partnerships, we have situations where both partners contribute capital and situations where one party, called the Rabbul Mal, contributes capital and the other party, called the Mudarabah, contributes time, effort, and labor. So the first is a Musharakkah. Both parties contribute capital, both parties can contribute effort. But if it's specialized where one party is the investor and the other party is the worker, then it's called a Mudarabah. So how are they used by contemporary Islamic banks? Musharakkah, as we saw, is being used to provide financing for service providers because service providers don't own many assets. So the assets cannot form the underlying basis of the contract. So typically you enter into a proper partnership with them. And Mudarabah, as we saw, is commonly used in investment banking, where you put your money in, so you're the investor, the Rabbul Mal, and the bank or the asset management company is the Mudarabah, the financial expert that will try to use that money to earn a return, and then you guys will share the profit. It is also used in Islamic pension schemes, which we'll look at later on. Under lease agreements, we have the typical rental agreement, and we have a rental agreement where the ownership is transferred as well. So if it's a regular rental agreement, it's a simple Ijarah. And if it's a rental agreement with an agreement to transfer the ownership as well, then it's Ijarah based on diminishing Musharakkah. So Ijarah is used for asset financing like we saw. Ijarah based on diminishing Musharakkah is also used for asset financing, only it's used in situations where you want that the party ends up owning the asset at the end of the day, so that the ownership is transferred from the bank to the borrower. Then for sales, we had different types of transactions. We had a sale where the cost and price are disclosed, a sale where the cost is not disclosed, just the price is negotiated, a sale of constructed or manufactured assets that take time to make, and sales with deferred deliveries of products or goods. So these were basically, the first one was Murabahah, second one was Musawamah, the third one was Istisna, and the last one was Salam. And how are these used by Islamic banks? So Murabahah and Musawamah are commonly used in asset and inventory financing. The bank buys the asset or inventory for a lower cost and then sells it on to the person who needs it. If the cost and price are both disclosed, then it's a Murabahah. If the cost is not disclosed, then it's a Musawamah. But these are very similar. Istisna, as we saw, is commonly used for financing for builders and manufacturers who need time to make their assets. And Salam, as we saw, was quite specialized. It's used primarily for financing of farmers and the agricultural sector. So hopefully now you have a good idea about how all these different Islamic finance models work. But as we said, Islamic finance is a niche in the larger market of conventional finance. So now let's compare and contrast some actual illustrations between conventional financing arrangements and Islamic financing arrangements. So conventional versus Islamic banking, let's say you want to buy a house. How would it work? We're going to look at a conventional finance arrangement and two Islamic banking arrangements. So the conventional finance arrangement, most of you would be familiar with it, you get a mortgage. So basically it's a loan to finance your buying of a house. You pay a portion of the price and borrow the rest from the bank. So you and the bank put in the money. You put in 10 million rupees, the bank puts in 90 million rupees. This is a loan to you, and you buy the house worth 100 million rupees. You pay interest and principal repayment on the loan. So for this 90 million loan, you'll make periodic interest payments, you'll repay the principal, and ultimately the loan will then be fully paid. The house will be collateral which the bank can claim in case of default. So if you're not able to make the loan payments back to the bank can come and seize your house and sell it off to recoup its money. But if there's any damage to the house, well, that's your problem, right? It's your house, that's your problem. And if there are any late payments, then the bank can charge you additional penalties. So if you don't pay the interest on time, the bank can charge you more interest. Now let's contrast this with some Islamic financing arrangements. We're going to look at a more ideal arrangement and a less ideal arrangement. So the more ideal arrangement would be Ijarah based on diminishing Musharakkah. So under this arrangement, you pay a portion of the price and the bank pays the rest. So you put in the 10 million rupees you have, the bank puts in the remaining 90 million. But in this case, there's no loan. You and the bank are now co-owners of the house. You own 10%, the bank owns 90%. You pay rent for using the bank's share of the property. So you move into the house, you start using it like you're the owner, but because the bank owns 90%, you have to pay rent to them for using their portion of the house. Now automatically you can see there's already a big difference. In the first case, in the mortgage, if something goes wrong, there's damage to the house, there's a natural disaster, you're the one who has to bear the loss, the bank is fine. In this case, you're co-owners. So if something happens to the house, as long as it's not from your own negligence, right? If it's a natural disaster, then both you and the bank jointly suffer the loss. You buy off the bank's share over time. Like we said, it's a diminishing Musharakkah. So you'll buy off the 90 million of the bank over time until you become the sole owner of the house. So you'll pay the rent over time and the purchase price until you become sole owner, and then the rental payments will stop as well. A slightly less ideal model would be Murabahah. Remember, Murabahah is a sale where you disclose both the cost and the price. So how would this work? Well, you would need to follow the steps meticulously, but if we were to give a summary, you and the bank enter an arrangement. You purchase the house on behalf of the bank. So you tell the bank, I need to buy this house. The bank will say, here's the money, you're my agent, go buy the house for me. So you buy the house on behalf of the bank for 100 million rupees. So the bank becomes the owner of the house. And then you enter a second arrangement with the bank where you buy the house from the bank for 120 million rupees. After that, you assume ownership and risk of the house because now you're the owner, you've bought it from the bank, the risk is with you. And you have to pay the 120 million, usually over time in terms of installments, but there's flexibility in that regard. The price is fixed, meaning the 120 million, once the contract has been entered, is fixed and there are no penalties for late payment like we previously discussed. And of course, the steps must be followed meticulously, otherwise the transaction is not Sharia compliant. And because there are steps and things can go wrong, that's why this is not an ideal form of financing. We would prefer the Ijarah based on diminishing Musharakkah. So now, hopefully, you also have an idea about how Islamic banking models differ from conventional banking models. But in this particular section, our focus has very much been on the financing side of things, the banking side of things. But obviously in finance, there's a whole other world, which is investment, where you want to earn returns. And in the next section, that's what we're going to look at. We're going to look at Islamic investing. So in this section, we're going to look at various contemporary investment options, such as stocks, bonds, mutual funds, real estate, and the like. We're going to look at each of them from an Islamic point of view to see whether it is considered halal or haram to invest in them. Before we get into the specifics, one topic we need to isolate and talk about first is derivatives and options. So these are generally complex financial instruments that are used to reduce risk. Derivatives, for example, forward or future contracts, are instruments which derive their value from something else, hence the name. Options, for example, call or put options, are instruments which allow you a choice in the future whether you want to exercise them or not. All of these and related instruments involve a level of ambiguity, speculation, or gambling, and are haram. Even if you find something called an Islamic derivative or option, for example, certain so-called Islamic banks or institutes offer Sharia-compliant derivatives or options, these are outright haram. Just by the nature of these instruments, there's always going to be a level of uncertainty, speculation, gambling, and as a result, there's no situation in which they can be considered halal. So now that we have them out of the way, let's look at some investment options that can potentially be halal. We're going to look at these different categories one by one, starting with stocks or shares. Just to make a note, the term stock and share is used interchangeably, and more often than not, they are used synonymously. There is a nuanced difference in the sense that stock is more of a generic term. For example, if someone says, I own IT stock, it means they own shares of various different IT companies. Whereas shares are something more specific. For example, I own shares of Apple or shares of Google. But commonly, these terms are used interchangeably, and we will do the same. After stocks, we'll look at bonds and Sukuk. Then we'll look at savings accounts, mutual funds, foreign exchange, also known as FOREX, cryptocurrency, real estate, and REITs, which are real estate investment trusts, and commodities. For each of these different areas, we're going to first understand what they are, and then look at them from an Islamic point of view to determine whether it is halal or haram to invest in these. Once again, the designation of something as halal or haram is based on fatwas from credible scholars, and links to all these fatwas are given in the description below. So let's start with stocks and shares. So what is the stock market? So companies can be privately or publicly owned. If you start a business partnership with some other individuals, you are the private owners, meaning you own all the shares of that company, you are the owners. Anyone else cannot just buy into the company unless you allow them. As for a publicly owned company, it is listed on something called a stock exchange, from where anyone from the general public can buy its shares. So typically, when the management or owners of a private company want to make it public, they list it on the stock exchange via an IPO. An IPO is an initial public offering. So usually at some point, a private company becomes large enough that the owners decide that either they want to sell it off or that they want to generate more funding so that they can grow it even further. And one of the best ways to do it is by listing the company on a stock exchange. The IPO, initial public offering, is the first offering of that company's shares to the public. And obviously, when the public starts buying shares of the company, there's a massive inflow of money, which can result in further growth for the company. So anyone from the public can then buy shares in a company listed on the stock exchange. So companies like Google or Apple listed on the stock exchange, anyone can go and buy their shares. These shares give the person part ownership in the company and entitles them to certain benefits such as voting rights at annual general meetings and dividend payments. So think of it this way: if a company has 100 shares issued and you buy one of those shares, you're 1% owner of the company effectively. And once you become a shareholder, you're given invitation to the annual general meeting, which is an annual meeting held at the end of every financial year, where decisions are made about the company and you can vote on those decisions. Likewise, it also entitles you to dividend payments. So returns on shares and stocks are in two ways: dividends and capital gains. Dividends are cash payments that companies make at the end of every period or every financial year from their excess profits. So it's a way to give back to their owners or their shareholders. Capital gains is increases in the share price. So if you buy a share at $100 and the share price increases to $150, you can sell that share and make $50 profit in capital gains. So these are the two main ways in which you make returns in the stock market. Now that we have an overall understanding of how stocks and shares work, let's talk about the Islamic consideration. Is investing in stocks or shares halal or haram? Well, we need to look at different aspects. Firstly, what are the company's core operations? So if their main operations are haram, then obviously it is haram to invest in such a company. Examples we've already seen before: any banks that deal with riba, any tobacco companies, any casinos, alcohol companies, weapons manufacturers. You cannot invest in these companies, you cannot own these companies, you cannot work for these companies. Then we have a company where the main operations are halal. Here we have multiple different scenarios. Scenario number one, that their main operations are halal and all their transactions are halal as well. In that case, yes, you can buy shares of this company. Examples would be a construction company or a halal restaurant that do not deal with any haram transactions. So they do not take out any loans which they're paying riba on, or they do not invest their money anywhere where it is earning riba, and they do not sell any products or services which are haram. Now obviously in real life, such companies are exceptionally rare that all their operations are halal and all their transactions are halal. More commonly, you'll find companies where the main operations are halal and their transactions are mostly halal. In such a scenario, there is actually a difference of opinion. There's two opinions. The more lenient opinion says that it is halal to invest in such companies, provided that the haram activities are below certain thresholds. The stronger, more robust opinion is that if the company engages in any haram activities or haram transactions, no matter how little they are, it is haram to invest in such a company. And the logic there is simple. If you were the owner of a company, you were running your own company, which a shareholder effectively is in a way, then if you were truly concerned about things being Sharia compliant, you would never go to a bank to get a loan and pay riba on it, or you would never sell something which is haram to sell. So in the same manner, why would you voluntarily buy shares of a company which you know is engaging in haram transactions, even if there are few and far in between? So examples of such companies would be supermarkets which sell alcohol. So the majority of their sales might be from halal products, but maybe 5-10% of their sales are alcohol or tobacco products. Other examples would be any companies which take out interest-based loans. So you could have a construction company or a halal restaurant or a regular restaurant which takes out loans and pays interest on it. Its main operations are all halal, but the act of paying riba on the loan is obviously not. And then you have a scenario where the main operations are halal, but the transactions are mostly haram. In such a case, there's no difference of opinion. It is haram to invest in such companies. Examples would be advertisement companies. So advertisement marketing is not haram in itself per se. But the way most marketing and advertisement companies work is that their ads include sexual content. There is often a lot of exaggeration about the product or deceptive practices in hiding some defects or shortcomings of the product. So as such, it is generally haram to invest in advertisement companies, even though the act of advertisement itself is not haram per se. Likewise, you could have restaurants where most of the sales come from alcohol. So even though the core operation of the restaurant is halal, most of its sales are not. Now, most of these cases are straightforward. The one area of concern that we might have is where there's the difference of opinion. So the more robust opinion says it's haram. That's straightforward and that's simple. And if you hold that opinion, then the majority of stocks and shares become haram to invest in because most companies deal in some level of haram transactions. But if you go for the more lenient opinion, which pretty much all Islamic banks and Islamic investment companies do, so you need to keep that in mind. If you hold the opinion that it is haram, keep in mind that Islamic banks and Islamic investment companies generally do not hold that opinion. So you might need to tell them not to invest any of your money in shares and stocks. But even if you hold that more lenient opinion, how do you determine if the transactions are mostly halal or if they're mostly haram? What is the criteria? There are some set rules of criteria which Sharia stock indices use around the world. So a Sharia compliant stock index is basically one which determines which company's shares are compliant with the Sharia and you can invest in it, and which company's shares are not. So if we look at a real life example, the Sharia stock screening criteria used on the Pakistani stock exchanges is one determined by Mizan Bank. More specifically, it is determined by the scholars on the Sharia board of the Mizan Bank. So Islamic banks have a Sharia board that advises them on all matters Islamic. So what is this criteria? The first one, the core business of the company should not violate any principle of Sharia, meaning it cannot be any of those prohibited companies we talked about, like alcohol, tobacco, weapons manufacturer, and so on. Secondly, the interest-bearing debt to total assets ratio should be less than 37%. So the way you should think about it is, a company's total assets that it has come from all the money it invests in the company. Now, companies have two sources of investment, either debt or equity. Equity is money the owners put in themselves. Debt is money that they borrow from somewhere else. So what we're saying here is that all of your financing and funding that goes into buying your assets, less than 37% of that should come from interest-bearing debt or debt on which you're paying interest or riba. That is the threshold set in this regard. But obviously, it's not just about paying interest, it's also about receiving interest. So the third criteria is that the ratio of non-compliant investments, meaning investment from which you receive haram returns such as riba, to total assets should be less than 33%. The fourth criteria is the ratio of non-compliant income to your total revenue should be less than 5%. So if we go back to our example of a supermarket which sells alcohol as well, as long as the sales of alcohol and other haram products are less than 5% of your total sales, then this metric is fulfilled. The fifth condition is the ratio of non-cash assets to total assets should be at least 25%. The reason for this ratio is that cash assets, meaning actual money, is not just kept lying around by companies. Rather, they typically invest this company in short-term investments like putting it into a savings account or a deposit. And these investments typically offer returns in the form of interest or riba. So that's why this ratio says that your non-cash assets should be at least 25%. The last criteria is that the market price per share should be greater than the net liquid assets per share. Basically, what this criteria is saying is that the value of your shares in the market should be more than the value of your cash per share. So if all 6 of these conditions are met, then the stock is considered Sharia compliant. So if we were to take an excerpt from the Karachi Stock Exchange Mizan Index, we have the following companies listed. We have the columns, the leftmost column being the company name, and then we have the 6 criteria columns, the debt ratio, investment ratio, income ratio, and the like. And in the final column to the right, we have the final Sharia status where the stock is determined to be compliant or non-compliant. So if any of the criteria are not met, the stock is considered non-compliant. So if we look near the top, we have 3 companies in a row: Artistic Denim Mills, Aga Steel, Agritech. All of these are considered non-compliant because they don't fulfill the criteria of the debt ratio being below 37%. We can see it's 45.87%, 41.76%, 59.91% respectively, and it's been highlighted in red. Now, those of you that are accountants would say, this whole system seems very iffy at best, because a lot of things in accounting are based on estimates. For example, depreciation expense is based on the useful life of the underlying assets, and that's subjective. A slight modification here or there can change your asset value or your profit value and the like. Likewise, in a lot of cases, valuing the assets themselves might be based on fair value, historical cost, and all of these can have an impact on how the assets are measured or the liabilities are measured. So you can easily have a company where some of these estimates, which are again subjective, are slightly adjusted and one of the ratios goes from Sharia compliant to non-Sharia compliant or vice versa. So does it make sense that a company whose debt ratio goes from 36% to 38% just from a change in a subjective estimate goes from Sharia compliant to non-Sharia compliant? Well, that's for you to decide. Like we said, the more robust and strong opinion, more commonly held by scholars, is that this criteria is irrelevant. If the company engages in any haram transactions, it is haram to invest in. However, this more lenient opinion is held by some credible scholars. So it is your prerogative on which opinion you choose to follow. And if you want to follow the more lenient opinion, like we showed you, there are certain criteria that you can use to determine if a share is Sharia compliant or not. And you have plenty of Sharia indexes that do this for you. Now, after stocks and shares, let's talk about bonds and Sukuk. So first of all, what are they? You can think of bonds basically as just a loan, because that's what they are. So you have what is called a bond holder, who is the lender of the money, and you have a bond issuer, who is the borrower of the money. So the bond issuer, as the name implies, issues the bond, which is basically a piece of paper, a bond certificate. And this includes the terms of the loan, that it will be for example, 5 years, and will pay an interest of 3% every quarter or every month, and so on. And once you get the bond certificate as a bond holder, you lend out the money, let's say $10,000, given as a loan to the borrower, the bond issuer. And then the borrower will pay interest payments on a periodic basis based on the terms in the bond certificate. And at the end of the term of the loan, will pay back the principal. Typically, bonds are issued by major companies. If they are unable to get loans from banks, then they issue bonds to raise financing in that manner. Now, what is a Sukuk? A Sukuk is generally called an Islamic banking bond because it shares a lot of similarities with conventional bonds. So, with a Sukuk, you also have a Sukuk holder, who is the lender, and a Sukuk issuer, who is the borrower. And the Sukuk issuer issues a Sukuk certificate to the Sukuk holder. But unlike in a bond where a loan is given, a Sukuk has an underlying asset or investment. So for example, if the Sukuk issuer needs the money to buy a machine to run their operations, the Sukuk holder will actually go buy the machine, let's say it's worth $10,000, and rent out the machine to the Sukuk issuer. And typically all these transactions are done with an SPV, a special purpose vehicle, serving as the middleman. SPV, just think of it as a small company set up for a particular purpose. In this case, the SPV will be managing all this operation. So they'll coordinate between the two parties, they'll go buy the asset, they'll go rent it out, and so on and so forth. But now, since there's an underlying asset, an actual machine in this whole scenario, the Sukuk issuer will make rental payments on using that machine instead of interest payments on a loan. And sometimes the option might be included that instead of just a simple Ijarah agreement where rental payments are being made, it's an Ijarah based on diminishing Musharakkah, where alongside the rental payments, the purchase price for the asset is paid over time as well, so that by the end of the Sukuk agreement, the asset ownership is transferred from the lender to the borrower. Now, Sukuks don't always necessarily have an asset as the underlying form of income. It's a more common one, but sometimes you might have an investment in a particular partnership or project and use that to generate profit returns instead of rental returns. But the whole idea is that instead of generating Riba or interest returns, you generate Halal returns like rent or profit. So if we were to compare and contrast bonds and Sukuk, what are the similarities and differences? So let's start with the similarities. Both provide periodic payment streams to investors. So bonds provide periodic interest returns, Sukuk generally provide periodic rent returns. So they're sort of seen as fixed return investments. Both are issued to raise capital. So someone issues the certificate if they need to borrow money or get financing to buy something. Both are considered less risky than equity because rather than having variable returns, they typically have periodic fixed returns. As for the differences, Sukuk has an underlying asset which is owned by the investor. So you're generating return on the use of that asset as opposed to just generating return on the money itself. Sukuk results in rental income, bonds result in interest income. A Sukuk's value changes based on asset value, whereas a bond's value changes based on credit rating. So these certificates, Sukuk certificates or bond certificates that someone is holding, can typically be sold in a market. So if you don't want to stay with the certificate until the end of the term, you can sell it to someone else. The Sukuk's value will change based on the underlying asset's value because that certificate effectively is showing that you own that particular asset. A bond's value will change based on the credit rating of the borrower. So if their credit rating goes down, the bond will become less valuable. If it goes up, the bond will become more valuable because it shows how reliably they'll keep making the interest payments. So from an Islamic point of view, what can we say? The general understanding is Sukuk are halal, bonds are haram. But notice the asterisk next to the halal for Sukuk. Just like with most things Islamic banking, just because someone says something is a Sukuk does not mean they're following the full mechanism that they need to follow. So yes, if a Sukuk is following the mechanism that we described, it is halal to invest in it. But you would have to do your due diligence because there have been many concerns over the years that a lot of Sukuk in the market are just there as a namesake and they're not actually Sharia compliant. So as long as the Sukuk are generating returns, for example, by collecting rent on an asset or by investing in a halal project, then yes, it's fine. But it needs to be investigated to make sure that that is actually the case. So just because a bank says it's Islamic doesn't mean it is. Just because a Sukuk says it's a Sukuk doesn't mean it necessarily is. Up next, let's talk about savings accounts. So first of all, what are they? So you have some extra money, some savings lying around. You want to earn a return on them, but you want the funds to be accessible to you as well in case you need them. So you deposit the savings into a savings account in a bank. What the bank does is it takes all this deposited money and it lends it or invests it. So it lends it out to people who need to borrow money, get loans, or it invests it in different investment options. These borrowers pay returns in the form of interest to the bank. These investments will result in a profit to the bank. So the bank collects all this interest and profit from all this money and pays a small portion of it back to you and the other depositors. So that's how you earn an interest on savings accounts. So, are savings accounts halal or haram? Well, conventional savings accounts deal with riba and are haram. So even if the bank statement says profit, it's interest basically, it's riba. And it is haram to invest in such savings accounts. Islamic savings accounts can be halal, but once again you will need to check whether their investment income is actually from halal sources. So instead of earning interest, they might be earning rental payment or profit from investing in business partnerships. In that case, their returns are halal, and then you can invest with that savings account. Now, you might find yourself in a situation where you need to open a bank account, but there are no Islamic options available. In that case, the scholars say you're not permitted to open a conventional savings account. You should instead opt for a current account. A current account is one which does not pay you any return. So you just keep your money there. It's easily accessible, but you're not earning any return on it. Up next, we have mutual funds. So what are these? A mutual fund is an investment vehicle. When someone buys shares in a mutual fund, they gain part ownership of all of the fund's underlying assets. So as an investor, you buy shares of a mutual fund. You can think of a mutual fund as a company which only deals with investing any money and earning a return on it. So when you buy shares of this mutual fund, this company, you become part owner of it. And this mutual fund, all the money put into it is managed by someone called the fund manager. This asset fund manager pools all this investment capital from all these different investors and then uses his financial expertise to invest it in various different areas. So he invests it in what is called an investment pool. Now, mutual funds are very diverse. There are funds for different purposes, for different objectives, in different types of instruments. So you can have mutual funds for short-term investments, mutual funds for long-term investments, mutual funds when you want a high return, mutual funds that only invest in the IT industry, mutual funds that only invest in stocks or shares, right? So the investment pool can comprise of a lot of things. There could be stocks, there could be bonds or sukuk, real estate investment, commodities, cryptocurrencies. You can have investments in one of these categories, some of these categories, or all of these categories. So any returns coming from all these investments will be paid back to the investors. So the returns will be first come to the mutual fund. So any dividends or capital gains from your stocks, any interest or rental payments from your bonds or sukuk, and so on. The mutual fund manager will take out their management fees and any portion of profit that they have, and the rest will be paid back to investors as dividends. Now, these are called dividends on paper, but technically they are whatever income the original investment earned. So if you have a mutual fund which invests in bonds and debt instruments, it's actually receiving and earning interest. So just because they call it dividends doesn't mean it's dividends. What you're earning effectively from this mutual fund is interest in that particular case. So are mutual funds halal or haram to invest in? So like we said, a mutual fund is essentially just a pool of investments. So rather than investing your money in one place, like a savings account or a particular bond or a particular share, you're investing in a lot of different places. It's a way to diversify your investment. So as long as the investments themselves are halal, then investing in the fund is halal. And there are many mutual funds out there that are Sharia compliant. If there are any haram investments, then it would make investing in the fund haram as well. So you would need to do your due diligence even for so-called Sharia compliant funds. But if all their investments are halal, then yes, you can invest in them, no problem. Up next, let's talk about foreign exchange. So what is that? The foreign exchange, also known as FOREX, is a marketplace where different currencies are traded. So globally, all these different countries have these different currencies. You have the dollar, you have the pound, you have the euro, you have reals, you have rupees, you have yen, and so on and so forth. So the foreign exchange market is simply where you can buy and sell all these different currencies against each other. Currencies go up and down in value relative to one another. This is usually due to changes in supply and demand of the currency, but there are a lot of different factors that impact currency prices. And obviously, these changes in prices create an opportunity to make a profit. So when the value of a particular currency goes down, you can buy it when it's cheap, and then when the value goes up, you can sell it and earn a profit that way. Currencies can be bought and sold over the counter from various traders and institutions, so they're generally very accessible the world over. The market is highly liquid, meaning money can easily be put in and out of the market, and allows for a lot of flexibility. There are a lot of ways in which you can invest and trade in foreign exchange, but can also be quite volatile. Because currency values are impacted by a lot of factors, political factors, economical factors, and the list goes on. So, is it halal or haram to invest in foreign exchange? So we already sort of saw a hadith mention that currency exchange can be practiced. It is halal to hold and trade currencies hand to hand, meaning spot transactions. You exchange it then and there. There's no delay in exchange. So you can use dollars to buy pounds or vice versa. But you must not engage in any haram transactions which are commonly found in the foreign exchange markets, such as futures contracts. So any derivatives contracts are not allowed. Margin trading. Margin trading is basically a way in which you engage in borrowing to leverage your buying and selling to make a bigger profit. But the whole transaction involves borrowing, and you pay riba or interest on the amount that you borrow. So it is haram. And likewise, short selling. You cannot sell which you do not currently own. Up next, let's talk about cryptocurrencies. Now, because this is such a hot topic these days, we're going to go in a bit of detail about what cryptocurrencies are and how they work, just so that you guys have a good understanding before we talk about the Islamic consideration. So cryptocurrencies, what are they? Cryptocurrencies are digital currencies, so they do not have any physical or tangible form. So they're not a piece of paper like a US dollar, they're not a coin. They exist in cyberspace, they exist as part of computer software. They were intended to provide an alternative to paper currency and the centralized banking system. When the 2008 financial crisis happened, it led to a lot of questions about the existing banking system and how it operated. And the founder of Bitcoin had this idea that the centralized banking system, the government, has too much control over our wealth and finances. Because every single transaction of ours flows through this centralized banking system. And if the government or the banking system screws up, just like it did with the 2008 financial crisis, it causes a great deal of problems for the rest of us. So he had the belief that we need to have a greater deal of control over our wealth and our money. And that's where he came up with the idea of using Bitcoin as cryptocurrency. Now, cryptocurrencies work with something called blockchain technology. What is blockchain technology? A blockchain is a special kind of database that relies on a decentralized storage and verification method. Lots of jargon here, let's try to unpack it. So when we say decentralized, what do we mean? So as we know, a database is a storage of data. When it comes to cryptocurrencies, the data being stored is obviously all the transactions, all the purchases and sales of the cryptocurrency. Now all of this data is stored in a decentralized manner, meaning there are multiple different nodes within the system. Think of a node as just an individual computer. All of these nodes are given a chunk of data from this overall system, which they need to store, process, and verify. And collectively, all the different nodes in the system verify all these different parts of data from within the system, and that is used to manage the entire database. So if we were to do a direct comparison between the centralized banking system and blockchain technology, which is used to operate cryptocurrencies, what are the key differences? So in the centralized banking system, data is stored and managed in banks' private databases. So each bank has its own private database where it stores all the transactions and financial data of its customers and clients. And typically, this data is also shared with other banks, with the central bank, with the government as well. And because banks have their own private individual databases, if someone is able to hack into a bank system, they can potentially get access to all their customer data. Whereas in a blockchain, transaction data is stored in a public ledger shared across the nodes. So every node or every computer connected to this blockchain will have access to the public ledger, which has all the data of all the different transactions related to that cryptocurrency. So if one of these nodes or computers becomes hacked or compromised in some manner, the other nodes will immediately be able to pick it up because everyone has access to the same data. They'll immediately be able to say that the ledger for this particular node does not match all of our ledgers. And in that manner, you can disqualify any such compromised nodes. So that can prove helpful when it comes to managing security. Then comes the matter of control. In the centralized banking system, there is an authority. The whole system is controlled and regulated by the central bank, which you can think of as the country's bank, and the government. Whereas in a blockchain, the control is spread across all the nodes. There is no single point of authority. In the banking system, data can be changed provided it's done by an authorized party. Obviously, there are a lot of checks and balances in place to make sure that this authority does not get misused in some manner. Whereas in a blockchain, the transaction data is immutable, meaning once the transaction has been entered into the blockchain, it is part of the blockchain permanently, and it has a permanent audit trail and it cannot be modified by anyone. Finally, in order to participate in the banking system, you must fulfill the requirements of the bank. So to open up a bank account, you need to have your verification, your background checks, declare your source of income. Everything needs to be linked to your name and your national identification number. So you need to comply by their regulations if you want to take part in the system. Whereas with cryptocurrencies, with blockchain, this is far more accessible. There's no real background checks per se. If you have an internet connection, you can connect to these blockchains and take part in trading these cryptocurrencies. So there's a lot more independence and freedom in that manner. But obviously, at the same time, the concern is that there aren't any background checks. So anyone can be participating in this system without any check being done on them. So due to this decentralization, there are better checks of data accuracy. Again, all the nodes will be checking and cross-verifying data across each other. There's more privacy because, like we said, there's no real checks to become part of a blockchain or cryptocurrency system. All you need is an internet connection. So you don't need to give your background information, your name, your national ID, or anything like that. And there's more transparency because the public ledger with all the transactions record is shared across all the nodes. However, transaction processing can be slow because in a decentralized system, like we said, there's individual nodes dealing with individual chunks of data. So for data to travel across this entire blockchain can take more time. It should also be noted that while these are famous for currency, crypto tokens have other uses as well. So crypto tokens are typically a form of currency within a particular software system. You can think of it kind of like in video games, you have their own individual currency systems. And just like in real life, you take a piece of paper, put a stamp on it, put a design on it, and say this is a US dollar and this is worth something. In the same manner, you take a crypto token and say this is worth something. And as long as enough people are willing to accept that value of that particular thing, it becomes currency. And since its inception, cryptocurrency has become far more popular. Famous ones like Bitcoin are becoming more widely acceptable. Many companies are starting to accept payments in Bitcoin. So it is an idea that does have momentum. So if we were to summarize the key differences, in the centralized banking system, you have this large system that is all interconnected, and all of your financial data flows through that system, and it is accessible by a local bank, by the central bank, by the government, and everything is linked back to you, your name, and your national ID. Whereas in a decentralized system, you do not need to declare your name or your national ID. You can just participate in the system itself. The data flow is shared across multiple different nodes. None of the nodes has authority or control over the other, and they work in a collaborative manner to just make sure that the data is all stored, processed, and verified properly. So it's far less regulated, it's far more private, and that brings with it a greater degree of freedom and independence for the individuals over this particular type of wealth. Obviously, at the same time, because it's less regulated, the system is more volatile. Cryptocurrencies have much more volatile values and prices compared to regular currency. And obviously, this lack of regulation can also lead to many illegal activities taking place in these particular fields. Let's also talk about the topic of cryptocurrency mining, because this is a common topic that you hear about. So let's get an idea about what this is all about. So blockchain mining is the computational work that network nodes undertake to verify and confirm the information contained in blocks. So remember what we said, a blockchain is a database comprised of multiple different nodes. Just think of it, multiple different computers. And each of these computers or nodes is given blocks of data that they need to store, verify, and the like. So mining can be very expensive, requiring large amounts of computational power. So dealing with all the data and its verification requires lots of computational power. And for providing this service, cryptocurrency miners are rewarded with what are called tokens. So cryptocurrency miners are basically serving as auditors for this information. They're storing it, they're checking it, they're cross-verifying it, and so on. And because this service is very essential and requires a lot of computational power, which means high-end computers, electricity costs, and the like, they need to be compensated. And they're compensated by crypto tokens, which is basically cryptocurrency. Cryptocurrencies generally have a fixed supply, so mining a particular currency becomes more difficult as time moves on. Now, this is something very important in principle. Cryptocurrency, or indeed any currency, should have a fixed supply, because fixed supply means that its value is more stable. That's why gold and silver are considered good types of currency, because they have a fixed supply. Their value is more stable compared to fiat paper currency, which you can print at any time, which has essentially unlimited supply. Think of it this way. The value of ice in Antarctica is little to none. The value of water in the ocean is little to none. the value of sand in the desert is little to none. Because if you have close to unlimited supply of something, the value of each individual unit of that thing is practically worthless. And that's a concern with fiat currency. Because the government can keep printing it, its value can become very volatile because its supply is, in a sense, unlimited. So the makers of cryptocurrency understand that and typically set a fixed supply for it. Now, this isn't a hard and fast rule. Sometimes these supplies get changed. All you need to do is basically change the code of the cryptocurrency. But the general understanding is that it needs to have a fixed supply. Now, the way the mining works is similar to a real-life mine. So let's say you have a mine with some valuable ore in it. When you start mining, you'll start mining right at the entrance of the mine. So any ore near the entrance will be mined out. And because this is very close by, there'll be a lot of progress and a lot of ore will be taken out very quickly. But once the entrance area becomes deplete, then you have to move further into the mine to mine more ore. And that means there's going to be more time taken to transport the ore back and forth, back and forth. And the deeper you go into the mine, the more difficult it will be to transport the ore back and forth. And cryptocurrency works in the same way. When a new cryptocurrency is launched, initially there'll be far less computational power required to mine the tokens. But as the supply depletes over time, it will require far more computational power to get the remaining tokens out. And that's the irony of cryptocurrency. The founder of Bitcoin wanted it to be something independent, something for the people at large to use, away from government control, from bank control. But because so much computational power is required to get cryptocurrency, and that means expensive computers with lots of resources, typically the overwhelming majority, we're talking 98 to 99% of cryptocurrency mining is being done by major companies or banks or governments. So in essence, it has sort of lost its original intended purpose. But again, this course isn't about cryptocurrency, it's about Islamic finance. So let's come back to what we need to talk about. Is investing in cryptocurrencies halal or haram? Cryptocurrencies by nature are very similar to regular paper currency, especially your fiat paper currency. And since that is considered halal to invest in, cryptocurrency follows the same rules. So it is permissible to trade in a hand-to-hand spot-based transaction. But once again, you cannot trade in certain transactions which are not allowed under paper currency either. So it is not permissible to trade if there are haram elements involved, which you commonly find in crypto markets. Short selling, any type of financial leverage such as margin trading, meaning any type of borrowing where you pay riba, any types of derivatives, all of these are prohibited just like they are for paper currency. That brings us on to real estate investment. So what is that? Real estate investment earns returns through trading properties or collecting rent on them. Real estate is basically land or buildings. So let's say you buy a house for $1 million. There's two main ways in which you can earn income on this house. Either you sell it to a buyer, let's say for $1.3 million, and earn a profit. Or you rent it out to a tenant and you collect rental payments from that tenant. Then you have something called REITs, or real estate investment trusts. So what are these? A real estate investment trust is a company which owns, operates, or finances income-producing real estate from across various sectors. So a real estate investment trust will have ownership of a lot of different properties and a lot of different buildings. Investing in an REIT is like investing in a mutual fund for real estate, where you buy a share in a pool of various real estate investments. So just like a mutual fund is a pool of different types of investments, an REIT is that more specifically for the real estate market. It's an investment in a pool of different real estate investments. So you buy shares of an REIT just like you buy shares of a mutual fund. REITs earn income from collecting rent on their properties, trading properties, or mortgages. And this is paid as dividends to the investors. So just like an individual, they can either buy and sell properties to make a profit, they can collect rent on properties, Or they can provide mortgages, which are basically loans. So if someone else needs to buy a property, you loan them money to finance their purchase and collect interest payments on them. But these are typically less popular. The majority of REITs collect their money from rent and from trading. So all these mortgage interest payments, profits from trading properties, rental payments are paid back to the REIT from these different properties. And the REIT, after deducting their management fees and their share of the profits, pay the rest as dividends to you, the investor. Since REITs deal with various sectors, for example, residential, industrial, healthcare, there is a lot of opportunity for diversification. So if we were to compare and contrast direct real estate investment versus an REIT investment, the way it works is, in direct real estate investment, you put your money in and buy a single property or a single building, and you own and control that property entirely on your own. So you can choose how to earn income on it, whether you want to rent it, whether you want to trade it, or the like. In an REIT, you don't own 100% of one property, you own 1% of 100 properties basically. So you own a small share of every property that REIT has invested in. You don't have much control or say over how these properties are managed or how the returns are earned. That's the job of the manager of the REIT fund. But it gives you a lot more flexibility. It gives you a lot more diversification because now you have shares in properties from residential areas, industrial areas, healthcare. And if any of one of these sectors is adversely impacted, some of the other sectors might be positively impacted, so the risk nets off against each other. Now the big question, is investing in real estate halal or haram? Investment in real estate and REITs is halal in principle as long as you avoid any haram transactions. This would include any income earned from mortgages. Like we said, a few REITs do earn income from mortgages, which is basically riba. So investing in such REITs would be haram. Any rent from properties with haram uses. So whether you're investing yourself and renting out your own property or through an REIT, you cannot rent out these buildings to companies which have haram operations. So your conventional banks, tobacco companies, casinos, you cannot rent it out to them. That income would be haram. But you can rent it out to businesses which have normally halal operations. So you can rent it out to a restaurant or a travel agency and the like. Lastly, let's talk about commodities. So what are commodities? These are raw materials and natural products. They include metals like aluminium, copper, steel, gold, silver, agricultural products like wheat, cotton, coffee, apples, oranges, natural resources such as crude oil, coal, natural gas. There are many ways in which you can invest in commodities. You can buy them directly, so you can buy bags of wheat, barrels of oil. You can buy shares of a commodity producing company. You could invest in a farm or an oil and gas company. Or you could invest in commodity funds, which are mutual funds which specialize in commodity trading. Because there are so many different types of commodities, if you want to get diversification, you would ideally want to invest in a commodity fund. That way you have some investment in aluminium and gold and wheat and natural gas and so on. So it gives you a more diverse range of investment. So is it halal or haram to trade in commodities? Transactions such as futures contracts, which are very commonly found in the commodities market, are obviously haram. Other transactions can be halal. For example, purchasing them directly on the spot. We can do a spot transaction, buy a bag of wheat for $100, sell it for $120 and make a profit. That's perfectly fine. We saw that the Salam Islamic contracts are basically there specifically to trade in homogeneous commodities. So as long as the Salam is following the conditions we discussed in the previous section, then it is halal to invest in commodities in that manner. And you can invest in a company or commodity fund which fulfills the Sharia requirements. So with that, we've covered a broad spectrum of a lot of the most popular investment options in contemporary finance, and we have analyzed them from an Islamic standpoint to see whether it is halal or haram to invest in them. This brings us to the last section of this presentation, where we will talk about other important financial matters. More specifically, we're going to talk about insurance and pensions. Both of these are very relevant financial vehicles that we will come across during our business or our work life. And as such, we need to be familiar with what they are and how they stand in relevance to Islamic finance. So let's start with insurance. What is conventional insurance? So an insurance policy is designed to transfer the financial risk of a policyholder to the insurance company. Now, this risk could be about a number of things. It could be the risk of an accident taking place. It could be the risk of your house catching on fire, right? It could be for any specific type of risk where you want to transfer that risk to an insurance company so that they fund you in the event that that risk actually materializes. So the policyholder makes regular payments, known as premiums, to the insurance company. The insurance company takes the funds from all these premiums being paid by the policyholders and it invests that money somewhere with the aims of earning a profit. Should the policyholder face a financial loss, they can file a claim with the insurance company. So should that risk actually materialize, for example, should your house catch fire and you have an insurance policy for that, then you can file a claim with the insurance company. The insurance company will verify whether that claim is valid, and in most cases they will try to avoid making any payments, but if the claim is valid, then they'll make a payout to the policyholder to cover the loss from the fire on the house in this case. So that's how a conventional insurance policy works. Now, the question is such an insurance policy halal? Well, conventional insurance includes three main haram elements. The first one is riba. So as we said, insurance companies collect all this money from the policyholders, from their premiums, and they invest them. And most insurance companies are not concerned with the investments being Sharia compliant or not. So a lot of their investments are in riba-based instruments where they're receiving interest. They can also charge policyholders interest if they're late in making their payments. Then there's the aspect of ambiguity. You do not know how much in premiums you will end up paying. So for how long you'll take out the policy, how many premiums you'll end up paying over what period of time, and you will also not know how much payout, if any, you will end up collecting from the insurance company. So there's a lot of ambiguity in this contract. So as we know, in Islamic finance, contracts need to be clear-cut. The terms need to be clearly stated on what the responsibility of each party is and how much money is going to be exchanged by both parties. There shouldn't be any such ambiguity. Lastly, there's an element of gambling. So you could end up in a situation where you make a few policy payments and then something happens, you file a claim, and you collect a large payout, though that is very unlikely to happen. In most cases, what's going to happen is you're going to end up paying a lot of premiums to the insurance company and in the end receive little to no payout. So you pay a lot of money, the insurance company pays you little to nothing back. So either way, whether you collect more money from the insurance company or you pay more money to the insurance company, there's an element of gambling and you don't know which situation is going to happen. So in light of this, what is the alternative that the Islamic finance industry came up with for insurance? Well, they started using a model called Takaful. So what is Takaful? Takaful is an Islamic alternative to the conventional insurance model. In Takaful, the members all contribute amounts to a pool of funds. So you have policyholders just like you have in an insurance contract. And just like in an insurance contract, these policyholders make contributions, just like they pay premiums in insurance, to a pool of funds. Now, this pool of funds is managed by an administrator who collects a fee for managing these funds. And this needs to be a pre-agreed fee that they'll tell you that this is how much fee we're going to collect for providing this service. And just like an insurance company, the Takaful will invest this money. However, the investment must be in Sharia compliant investment vehicles. So you cannot invest in instruments that pay you riba or the like. And in exchange, the whole purpose of this investment is, just like for an insurance company, to collect profits. The mutual understanding is that the funds in this pool that are being invested and earning a profit, the primary purpose of these funds is to protect all these policyholders from specific risks. So there's a mutual understanding. All the policyholders are putting their money into this pool of funds, knowing that there are other policyholders. And the agreement is that if any of us faces a financial loss, then we will take money from this fund to help that particular individual. So like we said, should any member of the fund face a loss from the risk, they will be provided an amount to cover it. For example, if one of the policyholders' house catches fire, they'll file a claim just like with a standard insurance company. And after the claim is verified, the Takaful will make a payout to that individual. So this is very similar to a family or community setting up an emergency fund for all of its members. So if a family decides that any extra money we save or any change that we get from our grocery shopping, we'll put that aside for an emergency fund. And if any of the family members faces an emergency, we will take the money out of this shared fund for that particular individual. That's what a Takaful is in the grand scheme of things. A community of people coming together, pooling their funds into one fund which is set as an emergency to help anyone who faces an emergency. So if we were to contrast conventional insurance with Takaful, what are the key differences? So in conventional insurance, the contract is between the company and the individual policyholder. There's no one else involved in that situation. In Takaful, the contract is based on risk sharing and mutual cooperation of all the members of that fund. In conventional insurance, like we said, there's Riba, there's speculation, and there's gambling. In Takaful, these issues are overcome. The issue of Riba and Haram investments is overcome because the Takaful will only invest in Sharia-compliant items. Furthermore, whereas for an insurance company, the main aim is to make a profit for the company, in Takaful, it does not work like that. So to take out the elements of speculation and gambling, yes, the company does take a management fee for managing the fund, but all the surplus funds belong to the policyholders. So when the Takaful fund runs its course, any extra funds left are paid back to the policyholders. Whereas in a conventional insurance company, that's not going to happen. Once the policy is out, the insurance company gets to keep the money. So in this way, the Takaful will do away with the elements of speculation and gambling. So does that mean that we're saying that if there's a Takaful, it is completely Sharia compliant in all cases? No, once again, we need to do our due diligence. There could be a company out there that claims to be following the Takaful policies, but if you look at what they say on paper and what they do in practice, they might be completely different. So we would have to do our due diligence, but yes, provided that the Takaful fulfills the requirements that we talked about here, then yes, it would be halal to use that as a form of insurance. So if we were to summarize all the various situations you might face when dealing with insurance, this is what we have. So if there's a Takaful and it's complying by the rules of the Sharia, then yes, it is halal to partake in it. If it's conventional insurance, you can have different scenarios. If it's a voluntary situation where you have a choice in whether or not you need to take that insurance, then obviously it would be haram to partake because of the reasons we mentioned previously. If you're in a situation where it's compulsory for you to take conventional insurance, for example, the government requires it of you or your company requires it of you. For example, in some countries, if you buy a car, you need to get car insurance. Because it's compulsory and you're forced into that situation, it is halal to take that conventional insurance, but even in those circumstances, you must take the most basic option. So you mustn't take the most fancy option and pay a large amount of premiums. Rather, you must take the most basic option with the minimum amount of premiums that you have to pay. And in the event that something happens and you need to collect a payout, you can only collect as much as you paid. So the amount of premiums you paid in, that is how much payout you can take. If there's anything excess paid to you, then you need to dispose of it. Then you have a rare circumstance of necessity. So scholars say that it is permissible to use health insurance in a case of extreme need. So if someone is facing financial difficulties and they can't get money from anywhere else, in that case scholars say it is permissible for them to use health insurance even if it's from conventional insurance. And lastly, there is a special case of social insurance being provided by the government. This is considered halal by the scholars. And this is a general principle. So any form of social benefits, whether it's insurance or otherwise, that is provided by the government to its citizens, scholars consider it halal regardless of where the investments were made or how the government earned this money. The reasoning for this is that they say the government is obligated to take care of its citizens, and the citizens have a right to receive any form of welfare from the government. So whether this is in the form of insurance or any other social benefit, it is halal for citizens to receive such money from the government. Now, all of the opinions expressed here have been taken from authentic Islamic sources and from credible scholars. And I've given links to the fatwas used to compile this graph in the description below. After insurance, we have pensions. So what is a pension? A pension scheme is a system whereby a portion of the salary is deducted and invested with the intent of providing a stream of payments to the employee after their retirement. So in other words, it is supposed to provide the person with a source of income after they are unable to work. So when you're young and you're able to work, you're earning a salary, that's your source of income. But when you get older and you have to retire or you're incapable of working anymore, how are you going to earn a living? You need to have a pension. And the way it works is they take some money from you right now, from your salary, and invest it somewhere. And after you retire, then you can collect money from that investment. Pensions come in various forms. For example, you have defined contribution plans where the risk is with the person themselves. So you make a contribution or the company makes a contribution on your behalf to a fund. And whatever the value of that investment at the time of retirement, that is how much money you'll be getting back. And there's a defined benefit plan where the risk is with the pension company or the company providing the scheme. And that they promise you that after you retire, this is the amount of pension you'll be receiving on a periodic basis. But the overall premise is the same. You're paying money right now to receive money later. The question is, are such pension schemes halal? So let's break it down from an Islamic standpoint. So with most pension schemes, there is going to be an element of uncertainty and gambling. How so? Well, you do not know how much of your salary will ultimately be deducted. How many more years are you going to continue working with the company? You don't know the future, so you can't really say. Likewise, you also do not know how many pension payments you will end up collecting after retirement. Some people might die immediately after retirement. Some people might live till 100. So you don't know how much money you'll end up collecting, nor do you know how much money you'll end up paying. So there's a lot of ambiguity in this whole transaction. Then there's the issue of the investment itself. Like we said, the money being deducted from you is being invested somewhere. The pension schemes generally invest these amounts. And if the sources of the investment are haram, then there's a problem taking money from those sources. Then there's the matter of choice. Pension schemes can be voluntary or compulsory. So sometimes companies or the government requires you to be part of a pension scheme. So what do you do in that situation? If it's compulsory, you might be forced into a pension scheme which has haram elements. And finally, there's the matter of where the pension scheme comes from. For example, certain countries, the governments offer pension. Once again, for this situation, just like we talked about with insurance, even if there are haram elements, for example, the government is earning this money from Riba, collecting pension from the government itself is considered halal, once again, because scholars say it's the state's responsibility to help its citizens and it's the citizens' right to receive any form of social welfare, whether it be insurance or pension, from the government, regardless of what the government did to earn that money. That's the government's problem, not the citizens. So, given the fact that there's uncertainty, there's gambling, there's potential in investing in haram investments, pension schemes are not really halal in the conventional sense. Then how do Islamic pension schemes work? Because there are Islamic banks out there that offer you Sharia compliant pension schemes. Well, an Islamic pension scheme is basically an investment fund that only invests in Sharia compliant investments. So it's basically just an investment fund, but you say that for this particular fund, I'm going to invest money right now and I'm only going to collect this money after I retire. So you plan the fund and you invest in the fund with that goal in mind. But ultimately, it's just like any Sharia compliant investment fund out there. It's just that you give the name that this is for pension purposes. These are defined contribution schemes. So like we said, pension funds can be defined benefit or defined contribution. And by and large, defined benefit schemes are considered haram. Now, there's some misinformation on this topic. For example, while doing research, I came across certain videos of individuals claiming to be scholars, saying that defined benefit schemes are halal because they're just like deferred salary, in the sense that the company is guaranteeing you a certain amount in the future. That's just like a promise to pay you this amount of salary in the future. But that's not true. There's no credible scholar that I came across that has ever subscribed to that opinion. So Islamic pension schemes are defined contribution schemes, and they're not like conventional pension defined contribution schemes. Because again, it's just an investment fund, a Sharia compliant investment fund, where you're collecting money after retirement. So you're trying to mimic a pension scheme without actually it being a pension scheme. So the only difference between you investing in a Sharia compliant fund and planning to use it to collect money after retirement and an Islamic pension scheme is that in an Islamic pension scheme, the bank will give you advice on planning and how to manage your taxes, how to manage your risk and return, given the fact that the bank knows that ultimately you intend to use this fund to mimic a pension scheme. That's all it really is. Because of this understanding, most Islamic pension schemes are very flexible, that even if you want to invest your money at a different level or withdraw your money early, they will allow you to do so, because effectively they're just a regular investment fund. It's just that it's trying to mimic a pension scheme without actually being a pension scheme. So if we were to break down the various situations you can come across when dealing with pensions, what would it look like? If the pension is from the state or the government, then like we said, it is halal to receive it. It's the government's problem on how they earn that money. Because it's the responsibility to take care of you, the citizen, you can receive any welfare from them, whether they call it insurance, whether they call it pension, or any other benefit. But if the pension scheme is being offered from your company, then there's multiple scenarios. Firstly, it might be voluntary, that they give you an offer that if you want to partake in this, you can, but if you want to refrain, you can. If there's any Islamic options available that are in compliance with the Sharia, then of course you can partake. If there's only conventional pension schemes being offered, then these are haram to partake in, because like we said, there's ambiguity, there's uncertainty, and they can potentially be investing this money in non-Sharia compliant investments, and obviously you can't earn returns from them. Now, you could have another situation where it is required by law or required by the company that you must partake in a pension scheme. In such a situation where you are forced to do so, you look for an Islamic option, and if that's available, then obviously it's halal to partake in that. But if that's not available and you're being forced to do so, then you can partake in a conventional pension scheme, but only to the extent of the actual contribution. Meaning, when you start collecting payments after your retirement, you cannot go over and above the amount of contribution that you made. Right? You can only collect up till the extent that you recoup your actual contribution that you made while working. Once again, the opinions expressed in this graph are all derived from the fatwas linked in the description below. Now, all of this leads to one last topic that we need to talk about. How do we dispose of haram income? So let's say you end up with some haram income. Maybe it was due to your ignorance in the past that you didn't know about the rulings and you ended up collecting something that was haram. Maybe you knew about it, but you made a mistake, you committed a sin, and now you want to repent for it. Maybe it's in the form of an excess insurance or pension payout that you've received that you have to give away. So all of this haram income, you can dispose of it by simply giving it away in charity. But it should be without the intention of expecting a reward, because this haram income, you can't receive a reward on that charity. You still have to give it away in charity to dispose of it in a Sharia compliant manner. And with that, we end our presentation. So hopefully you've learned a lot more about Islamic banking, Islamic finance, and Islamic investing, and you've gained more confidence over your grasp of this subject matter. Again, if you benefited from this course, from this presentation, please consider signing up to our website, where you will get access not just to this course, but many other courses like it. You will get access to our entire course library. With that said, thank you very much for watching, and I'll see you all next time.